isn't a story about millions. It's not a Wall Street fairy tale. These are my rules. Rules that built fortunes. Rules that buried the arrogant. Rules that can protect your capital and sharpen your edge, if you're wise enough to follow them. I didn't guess. I never trusted luck. I watched. I waited. And when the time was right, I struck. Hard. Most traders lose because they want action. They confuse movement with progress. They gamble. I didn't gamble. I operated. And now I'm going to give you the same rules I followed, the same rules I lived by, so that you don't have to learn the hard way like I did. Follow my rules, or lose everything. Before we begin, subscribe now, like this video, and leave a comment. That simple action helps more people see this content. And it tells me that sharing these lessons still matters. Now listen closely, because these rules were written in blood. My own. The market is never wrong. You are. There is only one side to the market, not the bull side or the bear side, but the right side. And the market is never wrong. Ever. You are. The sooner you accept that, the sooner you stop trying to outsmart something that doesn't even know your name. In my early years, I made one of the worst mistakes a trader can make. I tried to predict the market. I had a theory. I had logic. I even had confidence. But the market doesn't care about your confidence. I remember watching a stock push upward with strength, volume, momentum, everything was there. But I thought it had gone too far, so I sold short. I bet against the trend. You know what happened? The trend didn't care. The stock kept rising. I lost. Badly. That moment branded itself into my memory. I realized the market doesn't punish you because it's cruel. It punishes you because you refuse to listen. From that day forward, I stopped fighting the tape. I stopped trying to guess what should happen, and started reacting to what was happening. If the market tells you it's going up, you follow. If it says it's going down, you don't argue. Never try to prove the market wrong. You'll only bankrupt yourself trying. Your opinion doesn't move the market. Your money does. And if your money's on the wrong side, you're finished. Buy what's going up, sell what's going down. This rule is simple, but don't let its simplicity fool you. It will make or break your career. It never was my thinking that made the big money for me. It always was my sitting. I didn't buy stocks because they were cheap. I didn't buy them because I liked them. I bought them because they were moving up. Momentum isn't random. When a stock rises on volume, it's not a fluke. It's a signal. A signal that someone knows something. A signal that money is moving in. Most traders do the opposite. They try to catch the bottom. They look for discounts. But cheap stocks are cheap for a reason. Because no one wants them. I made my biggest trades on stocks that were already climbing. Railroads, steel, oil. The public called them overbought. I called them winners. Let me be clear. When a stock breaks out to new highs, and it does so with conviction, that's not the time to hesitate. That's the time to act. Same rule applies in reverse. If a stock is falling, don't try to be a hero. Don't try to guess where it might bounce, sell, or stay out. I made money by riding waves that already started, not by trying to start my own. The trend is your ally until you decide you're smarter than it. Then it becomes your executioner. This is not about catching the first penny. This is about positioning yourself in the direction of strength and staying with it until the market says otherwise. Never enter without a clear entry point. There's no room for hope in trading. Hope is not a strategy. Confirmation is. I never bought because I felt like it was the right time. I waited for the market to show me it was. Most people lose money because they want to do something, anything. They think trading is about being active, but trading is about being precise. I studied the tape. I learned to recognize what I called pivotal points, moments when price action confirmed a real shift. Not noise, not emotion, actual market intent. I'd sit and watch for hours, sometimes days. And when that point appeared, when the stock broke a level with volume, with strength, that's when I entered. Never a second before. Let me give you an example. There was a stock trading sideways for weeks. Most had given up on it, but I watched, quietly. I saw how it refused to go lower, how volume started creeping in. Then, bang, it broke through its resistance. That was my green light. I didn't chase noise, I waited for clarity. If you enter too early, you expose yourself to randomness. If you enter too late, the opportunity is gone. But if you enter with confirmation, with discipline, you give yourself an edge. I never guessed. I positioned. Let me repeat. Don't anticipate the market. Let it tell you what to do. Position size matters. I never went all in. Only fools do that. Position sizing is not just risk management, it's strategy. I built my positions as they proved themselves. If a stock moved in my favor, I added. If it moved against me, I cut or stepped back. Let me make this crystal clear. You do not double down on a loser. You add to a winner. When I entered a trade, I didn't buy my full size at once. That's gambling. I would start small, test the waters. If the trade began to work, if the market confirmed my direction, I'd increase size. Gradually, intelligently. Here's how I did it. Suppose I planned to buy 3,000 shares. I'd begin with 1,000. If the stock advanced and held, I'd buy another 1,000. Only if it continued to confirm strength, I'd buy the last 1,000. That way, the market paid me to increase my risk. Not emotion, not prediction, just logic and momentum. I was never afraid to go big, but only when the trade earned it. Too many traders blow up their accounts because they bet everything on their first move. They fall in love with the idea, and then they lose, fast. Your position should never be bigger than your discipline. Risk is always present. But when you build size based on strength, you shift the odds. I didn't build empires overnight. I built them one confirmed move at a time. Exits matter more than entries. Anyone can enter a trade, but only the disciplined know when and how to exit. And make no mistake, how you exit determines whether you win or just get lucky once. In 1907, I made my first real fortune. Not because I caught the top, not because I predicted the exact moment of the crash, but because I knew when to get out. While others held and hoped, I sold. I didn't need to time perfection. I just needed to protect profit and preserve capital. I followed the same rule every time. When the market tells you it's done, believe it. I'd watch price action shift, volume dry up, momentum weaken. These were not accidents, though they were signals, and I acted. Most traders don't fail because they can't find good entries. They fail because they let winners turn into losers, because they let hope replace discipline. I never married a trade. I never held just a little longer because I wanted more. If the market turned, I turned with it. Sometimes that meant giving up potential upside, but more often it meant keeping what I earned while others watched theirs evaporate. It's not how high it goes. It's what you walk away with. So remember this. You make money when you exit, not when you enter. A good trade isn't complete until you close it. On your terms, not the market's. Don't listen to advice. Listen to the market. Let me be honest with you. The worst losses of my career didn't come from bad trades. They came from listening to people, brokers, friends, newspapers. They all had opinions. And sometimes those opinions sounded brilliant. But they weren't based on the tape. They weren't based on price. They were based on ego, emotion, or noise. One time I ignored what the market was telling me, because someone I respected gave me inside information. The result? I held when I should have sold. I waited when I should have acted. And I lost. Badly. That was the last time I let someone else's voice drown out the message of the market. From then on, I listened only to the one thing that mattered: price action. The tape doesn't lie. It doesn't care about rumors, opinions, or predictions. It shows you what's real. Volume, direction, momentum. People will always try to sound smart, but the market doesn't reward sounding smart. It rewards being right, and that comes from watching, not talking. I trusted the market, and only the market. So here's my rule. Don't take tips. Don't follow crowds. Don't outsource your brain. If you can't trust your own analysis, you have no business trading. Learn the market. Read the tape. Build your edge. And when everyone's shouting, you stay silent and let the chart do the talking. Separate emotion from execution. Trading is not emotional, but traders are, and that's the problem. A man must believe in himself and his judgment if he expects to make a living at this game, but he must also act without emotion. I've made and lost fortunes, not because my system failed, but because I let fear, greed, and ego take over the controls. I've chased trades I had no business entering. I've hesitated on trades I should have executed instantly. Why? Because I was human. But I learned, painfully, that emotion is your enemy. It clouds judgment. It delays action. It whispers lies. You see, the market is already difficult. But when your emotions become part of your decision-making, now you're fighting two battles: the external and the internal. I had to build habits, rituals, rules I followed regardless of how I felt. If a trade hit my stop, I got out. If the signal came, I entered. No hesitation, no hope, no panic. Was it easy? Never. But necessary? Always. Discipline is what takes you from gambler to operator. I kept records. I reviewed my trades. I studied my own behavior as much as I studied the market, because I knew even the perfect system will fail if you sabotage it with your emotions. The biggest profits come when you do nothing. Let me tell you a truth that most traders never learn. The real money is made in the waiting, not in the trading. Everyone wants action. Everyone wants to feel busy. They think activity equals progress. But that's a lie. Some of my biggest profits came when I did absolutely nothing. I entered the trade, the setup was there. The price moved in my favor. And then I just sat. I didn't tinker. I didn't lock in small gains. I didn't try to be clever. I sat. I waited. I let the market work for me. Most traders destroy their profits by overmanaging. They cut winners too early. They chase new setups instead of letting a good one run. Why? Because doing nothing is hard. It feels like you're not in control. But that's the paradox. You gain control when you learn to let go. There's a famous quote they attribute to me, and it's true. It was never my thinking that made the big money. It was always my sitting. When the trend is in your favor, your job is not to outthink it. Your job is to hold. I built empires by sitting on trades while others were shaking out, second-guessing and scalping pennies. You want to know the secret? Patience pays more than talent. Discipline to enter is good. Discipline to exit is crucial. But discipline to wait, that's where the fortune lies. Learn from losses, don't excuse them. Losses are part of the game, but how you react to them defines whether you stay in the game or get wiped out. There is nothing new on Wall Street. There can't be, because speculation is as old as the hills. And still, every generation repeats the same mistakes. When I lost money, it was never because the market betrayed me. It was because I betrayed my own rules. I once made a fortune, then gave it all back. Not because the system stopped working, but because I stopped following it. I broke my own discipline, ignored my stops. Let pride speak louder than price. And then came the loss. It wasn't just money, it was time, it was momentum, it was confidence. But I didn't make excuses. I didn't blame the market. I sat with it. I analyzed the mistake, and I rebuilt, with sharper edges and fewer illusions. Every mistake carries a lesson. Most traders ignore it. That's why they stay broke. Losses are tuition. If you don't learn, you paid for nothing. You want to become a real operator? Then stop protecting your ego. Start protecting your capital. Don't justify a bad trade. Dissect it. Write it down. Study it. Because the only thing worse than a loss is repeating it. Success is a system, not intuition. If you remember only one thing from everything I've told you, let it be this. Success in trading doesn't come from feeling. It comes from structure, from rules, from system. I didn't rely on luck. I didn't trust my gut. I built a system, and I followed it. Rules for entry, rules for exit, rules for size, rules for sitting, rules for loss. Each one protected me from myself. The amateurs say, I just had a feeling. That feeling cost them their account. The pros say, I waited for confirmation. I followed my plan. I stuck to my system. That mindset built empires. Don't chase perfection. Don't chase magic setups. Chase consistency. Because in this game, it's not about being brilliant. It's about being repeatable. If your strategy can't survive your emotions, your drawdowns, or your mistakes, it's not a strategy. It's a bet. I lost everything, and I came back because I had rules, because I had structure, because I didn't let failure become final. You want to survive this game? Then stop guessing. Start building. Build a system. Stick to it. Adjust it. And respect it more than your own opinions. You don't need luck. You need discipline. You need control. You need rules. Follow my rules, or lose everything. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. The path of the speculator is paved with the ghosts of failed accounts, a testament to the brutal, unforgiving nature of the game. So many enter the arena armed with hope and a handful of tips, only to be swiftly and mercilessly separated from their capital. They fail not for a lack of intelligence or courage, but for a lack of a coherent, disciplined philosophy. They are playing a game of chance while the masters who endure are engaged in a serious, calculated business. Jesse Livermore, through a lifetime of spectacular victories and devastating defeats, codified the unwritten laws of this business. He did not leave behind a magic formula, but something far more valuable, a set of foundational golden rules that serve as the ultimate defense against the market's perils and the speculator's own worst instincts. He learned that success in speculation is not an accident. It is the result of a lifetime of study, of constant observation, and of unwavering adherence to a set of immutable principles. To violate these principles, he discovered, was to invite certain ruin. To follow them was to align oneself with the great, powerful forces that govern all market movements. These are not suggestions or guidelines. They are the commandments of speculative survival. The trader who ignores them is destined to join the silent, impoverished majority. The one who masters them is given the key to unlocking the vast potential of the market. What follows is a dissection of these golden rules, the very architecture of Livermore's legendary success. They are principles forged in the heat of battle, paid for with millions of dollars in losses, and ultimately responsible for the millions more that he won. They are as relevant today as they were a century ago. For while the stocks, the players, and the technology may change, the underlying game, governed by the unchanging forces of human greed and fear, remains eternally the same. These rules are the speculator's ultimate shield. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed, chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The first and most foundational of all Livermore's rules was to trade with the primary, underlying trend. He understood, with a clarity that eluded most of his contemporaries, that prices move along what he famously termed the line of least resistance. This was not a mystical concept, but a simple practical observation. Prices will do whatever comes easiest. They will go up if there is less resistance to an advance than to a decline, and vice versa. The speculator's entire job, as he saw it, was to correctly identify this path and to align his operations with it. He was adamant on this point. One must not argue with the market's condition, and most of all, one must not try to combat it. To be a bull in a bear market or a bear in a bull market was not a sign of courage, but of foolishness. It was to pit one's own small, finite resources against an irresistible, impersonal force. This was a battle that could have only one outcome. The successful speculator does not fight the trend. He joins it. He is the surfer who rides the great wave, not the swimmer who tries to fight against the tide. This principle required a profound level of patience. It meant refraining from trading for long periods, waiting for the market to declare its own intentions. There are times, he insisted, when one should speculate. And just as surely there are times when one should not speculate. The wise trader is the one who knows the difference, who has the discipline to stay out of the market when the line of least resistance is not clearly defined, when prices are moving sideways in a narrow, confusing range. It is in these periods of indecision that the amateur loses his capital, chipping it away on meaningless, unprofitable trades. The second golden rule is perhaps his most famous, a piece of wisdom so essential that it should be etched into the mind of every person who ever dares to place a trade. Cut your losses quickly. Livermore learned at a cost of millions that this was the single most important principle for capital preservation. He stated, with the certainty of a man who had seen the alternative, that profits always take care of themselves, but losses never do. A losing position is a problem that, if left unattended, will only grow worse. He believed that the first loss was always the best and smallest loss. It was a small, manageable price to pay for the information that your initial judgment was wrong. To hold on to that loss, to hope that it would come back, was to substitute wishful thinking for sound business practice. It was to allow a small, treatable wound to fester into a gangrenous, life-threatening infection. The speculator, he insisted, must be his own insurance broker, and the only way he can insure himself against a catastrophic loss is by taking the first small one. This rule is a direct assault on the speculator's most powerful emotional enemies, hope and ego. When a trade goes against him, the amateur hopes for a reversal. His ego, which hates to admit a mistake, convinces him to give the trade more time. Livermore knew this was a fatal combination. The professional, he believed, must act on a healthy and rational fear when he is losing. A fear that the small loss could develop into a much larger one. This fear is not a weakness. It is a catalyst for the decisive, disciplined action that ensures his survival. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not confined to a single individual. The history of speculation is rich with masters who, while sharing Livermore's core respect for risk, developed their own unique styles. From the mechanical box theory of Nicholas Darvas, to the volume spread analysis of Richard Wyckoff, to the turtle trading system of Richard Dennis, from the deep value principles of Peter Lynch, to the pioneering trend analysis of Charles Dow, and the modern psychological insights of Ed C. Cota, there is a pantheon of genius to study. To explore this rich history, we have launched a new channel dedicated to the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding, the link to this new channel is in the description below. The third golden rule is the offensive counterpart to the defensive act of cutting losses. It is the principle that allows a speculator to capture the great fortune-making moves. The rule is this: let your profits run. Just as the amateur is crippled by hope when he is losing, he is crippled by fear when he is winning. He sees a small, quick profit and is seized by the fear that it will vanish. He sells too early, snatching a few points from a move that may have 100 points yet to run. He is, as Livermore said, growing rich by taking a 4-point profit in a bull market. Livermore's most profound realization, the one that elevated him from a successful plunger to a legendary speculator, was that the big money was never made in the day-to-day fluctuations. It was made by sitting tight. He recounted the story of Old Man Partridge, a wise trader who, when asked for his opinion in a roaring bull market, would simply reply, "Well, you know this is a bull market." This was not a flippant remark. It was a piece of profound wisdom. It was a reminder that in a great trend, the speculator's job is not to trade, but to hold his position, to have the courage and the patience to ride the move for all it is worth. This requires an almost superhuman level of emotional control. It is the ability to sit through the normal, healthy reactions that are a part of every major trend without being shaken out by fear. A profit, Livermore knew, was the market's own confirmation that your judgment was correct. To abandon a position for which you have such powerful validation is an act of strategic folly. The speculator must learn to be as patient with his winning trades as he is impatient with his losing ones. The fourth golden rule is a direct and forceful prohibition against the speculator's most self-destructive habit. Never average down a losing position. Livermore considered this the cardinal sin of speculation, a practice so fundamentally flawed that it was guaranteed to lead to ruin. To buy more of a stock that has already declined is to reinforce failure. It is to argue with the tape's clear verdict that your initial judgment was wrong. It is to throw good money after bad in a desperate, ego-driven attempt to prove the market wrong. He stated with the force of an unbreakable law, of all speculative blunders, there are few greater than trying to average a losing game. He knew from his own catastrophic experiences, particularly his disastrous cotton trade, that this practice transforms a small, manageable loss into an uncontrollable, account-destroying disaster. It is an act of pure hope, and hope in a losing position is a lethal poison. The professional never hopes his way out of a bad trade. He cuts his way out, preserving his capital to fight another day. The fifth golden rule provides the professional's alternative to averaging down. It is the constructive, wealth-building strategy that stands as its polar opposite. Pyramid your winners. Livermore's method was to never commit his full capital at once. He would begin with a small, exploratory position. If and only if that initial trade showed him a profit, would he add to it. He would buy his second lot at a higher price than his first and his third at a higher price than his second. He was averaging up, not down. This strategy ensures that the speculator's largest commitments are always made in trades that are already successful. He is not funding a losing battle. He is reinforcing a winning one. The market itself is financing his increased exposure through his accumulated paper profits. It is a strategy built on confirmation, not on hope. It requires the discipline to buy at prices that seem high to the amateur, but that the professional recognizes as a sign of confirmed strength. By reinforcing success and ruthlessly abandoning failure, the speculator aligns his capital with the market's primary force, the very definition of intelligent trading. The sixth golden rule in Jesse Livermore's arsenal was the cornerstone of his timing, the very mechanism that protected him from the market's most common and costly traps. He would always wait for confirmation. The amateur speculator is a creature of impatience. He is driven by a constant, anxious need to be in the market, fearing that if he is not participating at all times, he will miss the next great move. Livermore knew this hankering for activity to be a fatal flaw. He understood that the great opportunities, the high-probability trades that build fortunes, are rare and episodic. They do not appear every day, or even every week. The speculator's job is not to trade, but to wait patiently for the market to give its unequivocal signal. This signal for Livermore came at what he called the pivotal point. This was not a vague feeling or a hunch, but a specific, identifiable price level where the battle between buyers and sellers had reached a decisive conclusion. It was the moment a stock was ready to move, the point at which the line of least resistance was clearly established. To enter the market before this point was to gamble on an opinion. To enter at the pivotal point was to act on the market's own confirmed evidence. This required a level of patience that few possess. But it was the key to being right from the very start. His own disastrous experience with cotton, where he lost a small fortune by jumping in 5 times before the market was ready, burned this lesson into his soul. He had been correct in his analysis that a great bull move was coming, but he had been disastrously wrong in his timing. His impatience cost him the $1 million move he had so clearly foreseen. From that point on, he made it an ironclad rule to wait for the psychological moment, to let the market reach his predetermined price before he would commit a single dollar. The 7th golden rule was the foundation of his longevity, the principle that allowed him to survive the inevitable losing streaks and market panics that wiped out so many of his contemporaries. He would manage his capital with the utmost seriousness. He knew that a speculator's capital was his lifeline, his ammunition, his very means of conducting business. To risk it recklessly on a single trade, no matter how certain it seemed, was an act of business suicide. He was not in the game to be a hero for a day. He was in it to be a king for a career. This meant never betting too big. He understood the brutal mathematics of ruin. A single large loss can require a series of impossibly large wins just to get back to even. Therefore, he would only ever risk a small, manageable fraction of his total capital on any single idea. He used the famous story of the nervous cotton trader who couldn't sleep, whose friend advised him to sell down to the sleeping point. This was more than a clever anecdote. It was a profound piece of wisdom. A speculator who cannot think clearly and dispassionately because he is worried about the size of his position is a speculator who is guaranteed to lose. Livermore also practiced the discipline of securing his winnings. After a successful and substantial deal, he made it a habit to take half of his profits and lock them away in a safe deposit box. He knew the seductive danger of easy money, how it can lead to carelessness and a loss of balance. By physically converting his paper profits into real, tangible cash and putting it out of reach, he protected himself from his own potential for future recklessness. It was a mechanical defense against the human tendency to give back what the market has given. The 8th golden rule was perhaps the most difficult of all, for it required the mastery not of the market but of oneself. Control your emotions. Livermore stated unequivocally that the speculator's chief enemies are always boring from within. These enemies were not the bare syndicates or the inside pools. They were the two most powerful and primal of all human emotions, hope and fear. He knew that in the market, these two instincts are almost always inverted to the trader's detriment. The average man, when in a losing trade, is filled with hope. He hopes the market will turn, that his stock will come back. This hope, Livermore knew, is a poison. It keeps a man locked in a losing position long past the point of rational return. Conversely, when the average man has a profit, he is filled with fear. He fears the profit will vanish, and so he snatches it too quickly, cutting short a potentially great move. This fear cheats him out of the big money. Livermore's great psychological secret was that he consciously and deliberately inverted these two emotions. He forced himself to fear when he was losing and to hope when he was winning. When a trade went against him, he became fearful that the small loss could become a catastrophic one, and this fear drove him to cut it immediately. When a trade went in his favor, he became hopeful that this was the start of a major trend, and this hope gave him the courage to sit tight and let his profits run. This rewiring of his own natural impulses was the source of his legendary poise and discipline. The ninth golden rule was a principle of strategic focus. Follow the leaders. Livermore knew that it was a mistake to try and trade the entire market. He stated, "It is much easier to watch a few than many." To spread oneself too thin was to invite confusion and dilute one's analytical power. He believed that the real money was always made in the leading active issues. If you cannot make money out of the leading active issues, he asserted, you are not going to make money out of the stock market as a whole. This meant focusing his attention on the strongest stocks in the strongest industry groups. In a bull market, he would identify the group that was leading the advance, and then he would concentrate his operations on the most powerful stock within that group. He learned to beware of the laggards. The amateur is often tempted to buy a stock that has not moved, believing it is cheaper and due for a rise. Livermore saw this as a fatal error. A stock that refuses to follow its group leader in a strong market is a stock that is advertising its own profound weakness. His trade in Chester Motors was a classic example. While the entire automobile group was soaring in a bull market, Chester stubbornly refused to advance. The public, seeing it as a bargain, began to buy. Livermore, reading the tape, saw this not as an opportunity but as a grave warning. The fact that the stock could not rally despite the bullish conditions in the public buying was a clear sign of disguised inside selling. He did not ask why. The tape's action was all the reason he needed. He sold the stock short and profited handsomely when its internal weakness was finally revealed to all. The 10th and final golden rule was a powerful injunction against the most seductive of all market temptations. Beware of inside information. Throughout his career, Livermore was bombarded with tips, rumors, and supposedly secret information from men who claimed to be in the know. He learned, through costly experience, that acting on such information was one of the quickest and most certain paths to ruin. He came to a profound conclusion. The tape is the ultimate authority, and its verdict must be trusted above all other sources. He understood the insider's dilemma perfectly. An insider might tell you when to buy a stock. He might even be sincere. But he cannot and will not tell you when to sell. To do so would be an act of treason against his own associates and his own financial interests. Therefore, the trader who acts on a tip is placing himself in a position of utter dependency, a man who has been led into a theater but has not been told where the exits are. Livermore came to trust the action of the market itself so completely that he would often trade in direct opposition to what he was being told by supposedly well-informed sources. He knew that if there was genuine inside buying, it would be reflected in the price action on the tape. If the tape did not confirm the tip, then the tip was worthless, or worse, a deliberate deception. He famously advised that every speculator should write on the first page of his notebook, in indelible ink the words, "Beware of inside information. All inside information." These 10 rules taken together form a complete and coherent philosophy of speculation. They are a system of thought and action designed to protect the speculator from the market's dangers and from his own worst enemy, himself. They are not a guarantee of profit, for speculation can never be made entirely safe. But they are a guarantee of survival. They provide the discipline, the framework, and the psychological fortitude required to stay in the game long enough to capitalize on the great fortune-making trends. This was the ultimate legacy of Jesse Livermore, a set of golden rules that remain as true and as essential today as they were a century ago. The greatest killer of speculative fortunes is not the crash, not the bear market, not the clever manipulation of the insiders who try to shake you out. No. The true killer is far more insidious. It is the 3 seconds between seeing a potential opportunity and waiting for that opportunity to confirm itself upon the tape. That gap. That momentary failure of nerve. The gap of impatience. This is the market's toll booth, designed specifically to extract capital from the impulsive. The quick hand, the nervous entry, the eager fool. If you cannot master the discipline of waiting for absolute proof, the market will treat you like a common gambler, and you will lose everything you possess. You must understand this truth immediately. The impulse to trade is a destructive instinct. The disciplined waiting for the signal is the highest form of professional speculation. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The immediate, impulsive urge to get in now is the market's oldest, most reliably fatal trap. It springs from the twin fears: the fear of missing out on the first tick, and the fear that the price will run away from you before you establish your position. This impulse is an emotional reflex. It has no place in speculation. The danger of trading on impulse is simple. You are acting on hope, not evidence. You are betting that your personal assessment, your prejudgment, will override the factual movements of the general market. This is a disastrous conceit. The professional operator waits, he watches, he confirms. The amateur rushes, he hopes, he buys on the rumor of a move. The most common error I have witnessed day after day, year after year, in the room and on the floor, is the failure to wait for the crucial confirmation point. The speculator sees a stock turn up 2 points. The impulse shouts, "Buy now. If you wait, you will pay more." So the impulsive trader rushes in. He buys immediately, saving perhaps a half point or a full point on the entry price. He feels clever. He feels fast. But what happens next? That half point saved on an early entry often costs 50 points later. How? Because an impulsive entry is inevitably a poorly positioned entry. When you enter too soon, you do not have a confirmed line of least resistance. You have only an expectation. The stock often pulls back to test the very level you just rushed past. The fluctuation that follows the premature entry causes immediate distress. The capital is now held captive in a nervous position. The speculator is immediately placed on the defensive, forced to watch the tape with anxiety, calculating whether he must violate his own rule and cut the position before the major move he anticipated has even begun. He becomes emotionally invested immediately. The position is small, but the stress is immense. He has ruined his clear judgment. A professional entry is made when the market has proved its willingness to move in the desired direction. A professional entry allows for a much tighter, more logical stop loss because the risk has already been partially mitigated by the market's initial action. An impulsive entry based on a hunch requires a wider stop. Why? Because the market has not yet decided its path. You are exposed to the maximum amount of fluctuation. If you save 1 point by rushing in early, You often risk 10 points just to survive the initial unnecessary shakeout. That one saved point is a false economy. It is the cost of impatience. The operator who waits, who pays the slight premium for confirmation, enters the market with clarity. He knows exactly why he is there. He has proof. He buys the stock after it confirms the break, not before it breaks. This patience allows him to sleep at night. It maintains his mental clarity. He is trading on evidence, and the market's inevitable fluctuations, though annoying, do not threaten his confidence or his position because he knows the primary signal remains intact. Impulse destroys judgment. It shifts your focus from what is the market doing to what is this stock doing to me. Never allow the urge to save a minor fraction on the entry price to dictate your timing. Time is infinitely more valuable than a few ticks. Wait until the market gives you permission to proceed. You must learn to distinguish between a hunch and a signal. They feel similar to the untrained speculator, but their origins and consequences are worlds apart. A hunch is rooted in desire. It is based on the emotional dread of missing the coming movement. It is often triggered by gossip or a momentary sharp spike on the tape that catches your eye. A hunch is fundamentally subjective. It is the hope that you are smarter than the entire market and that you can predict its immediate future. A hunch is usually a justification for risk. A signal is the opposite. A signal is concrete. It is derived entirely from market action, from the indisputable behavior of the price and volume around critical points. A signal is objective proof. I learned early in my career, particularly during the heady days of the cotton market, that I rarely traded on the first interpretation of events. My initial analysis might suggest a certain course, but I always waited for the market itself to affirm that analysis. The market has a way of showing its hand, but only after it has tested the patience of the crowd. A genuine signal is the unambiguous proof of the line of least resistance. It is the moment when the market has clearly stated that it requires less effort to continue in one direction than to reverse. A hunch is merely an emotional justification to risk capital immediately. Consider a stock that has been accumulating for weeks within a tight range. You, having studied your charts, believe it is about to break upward. The price begins to rise slightly, touching the top of the range. The hunch says, "This is it." Buy the moment it touches the high. The signal demands patience. The signal requires not just the touch of the high, but the clear, sustained penetration of that high. It demands that the price holds above that resistance, confirming that the forces of buying are overwhelming the forces of selling at that crucial point. Until that happens, the initial spike is merely a transient fluctuation, a probing action. It is designed to trap the impulsive buyer and allow the experienced operator to unload paper into nervous hands. The hunch invites you to buy the probe. The signal invites you to buy the established breakthrough. A true signal requires time and clarity. It must be repeatable evidence. It must demonstrate institutional support or overwhelming public sentiment. It cannot be fleeting. If you are acting based on a gut feeling, a whispering voice, or a tip you overheard in the smoking room, you are operating on a hunch. If you are acting because the price has closed above the confirmed resistance line, on heavy volume, and held that position for a sustained period, you're acting on a signal. The difference determines whether you are a gambler or a professional speculator. One relies on luck, the other relies on observable fact. Never trade on a hunch. Only trade on the undeniable confirmed signal. The signal is never merely a single price point. That is a dangerous simplification. The signal is the sustained behavior around a critical level. This is the principle of complete confirmation. Many speculators are defeated because they accept a partial confirmation as the final word. They see the stock touch the high, and they assume the move is underway. They do not wait for the market to complete its work. The market must not only reach the desired level, it must hold that level. It must show resilience against the inevitable selling pressure that arises when a resistance point is tested. You must wait for the market to complete its move and hold its position, confirming that the forces driving the move are genuine, sustained, and overwhelming. Think of an army advancing on a fortified position. They do not merely touch the fortress walls and declare victory. They must breach the walls, secure the perimeter, and demonstrate that they have enough occupying force to repel the counterattack. The stock price is the same. When it pierces a significant resistance level, the sellers will naturally appear, those who bought lower and are taking profits, and those who are shorting at the perceived high. If the breakthrough is genuine, the buyers will absorb that selling pressure easily. The price will dip, but it will not retreat below the key level. It will consolidate above it, proving that the foundation for the new higher price has been established. That consolidation, that holding action, is the final essential part of the signal. An early entry preempts this confirmation. It invites volatility to annihilate your position. If you buy the first touch of the resistance, you are sitting right in the middle of the most ferocious battle. You are highly likely to be thrown off by the ensuing chaos, regardless of the true direction of the ultimate move. If the stock breaks through 100, do not buy at 101/8. Wait until it touches 101, pulls back to 101/2, and then moves decisively toward 102. That action, the breach, the test, the resumed advance, is the confirmation. It is better to miss the first 2 points of a 20-point move than to be shaken out of the entire 20 points because you entered before the confirmation was complete. The market has a malicious tendency to punish the premature entrant by giving them a brief glimpse of profit, only to reverse violently enough to trigger a stop, leaving the speculator bruised, frustrated, and out of the position just before the true confirmed move begins. This is why complete confirmation is paramount. It separates a transient fluctuation from a sustained trend. It forces you to rely on facts, not possibilities. Be patient enough to let the market show its true colors. Perhaps the most frustrating experience for a speculator is to be fundamentally right about a major move, yet still lose money because of impatience. The high cost of being right too early is measured not just in dollars, but in the catastrophic drain on confidence. If you enter prematurely, you are likely to be shaken out by minor fluctuations while the underlying move is still forming. The market can be frustratingly, deliberately slow. Great movements often take weeks, even months, to ripen fully. The initial stages are often characterized by false starts, sideways drift, and sudden, deceptive reversals. You, having entered on your early hunch, find yourself waiting. The stock moves 1 point in your favor, then 3 points against you. It lingers. It becomes tedious. You start to doubt your fundamental reasoning, not because the market action contradicts it, but because the lack of immediate progress wears down your certainty. The market does not care that you are fundamentally correct. It cares only about timing. If your timing is off, even by a few days, you invite the kind of volatility that forces your liquidation. You exit the position, perhaps taking a minor loss or a meager profit, simply because you cannot bear the prolonged uncertainty. The position was not working yet, and your early entry exposed you to the maximum psychological strain of waiting. Then, inevitably, moments later, the true movement begins. The stock that bored you for 3 weeks suddenly explodes, moving 10 points in 2 days, and you were right, but you were impatient. The market exacts a severe toll for this error. First, you lose capital on the unnecessary stop-out. Second, you miss the profit of the subsequent move. Third, and most damaging, you suffer a profound loss of self-trust. You saw the opportunity, you acted, but your timing was so poor that the correct action resulted in failure. This undermines the very foundation of successful speculation. The market's job in its early stages is to accumulate. It gathers shares from the weak hands and the impatient. If you enter early, you become one of the weak hands. The market must shake you out before it can ascend freely. Waiting for the signal means allowing the accumulation phase to complete. It means allowing the large operators to finish their work absorbing all the selling interest until the path is clear. When the signal finally arrives, it often coincides with the moment the waiting is over. The stock moves quickly, decisively, and usually without a significant early retracement. If you are determined to enter early, understand that you are volunteering to be shaken out. You are paying the volatility premium. You are sacrificing your emotional reserve. The cost of being right too early is often higher than the cost of being wrong entirely, because being right too early guarantees disappointment and often leads to catastrophic revenge trading later on. Wait for the train to be moving, not just warming the engine. Many speculators view cash as a neutral state, a temporary pause between positions. This is fundamentally incorrect. Cash for the disciplined operator is not a neutral state. Cash is the ultimate strategic position. Waiting is not inactivity. Waiting is intelligent positioning. When you are holding cash, you are holding maximum optionality. You are immune to the minor fluctuations of the tape. You are detached from the emotional demands of an open position. Your mind is clear and your power to act decisively is at its zenith. Cash provides the critical vantage point necessary for proper market observation. As long as you are invested, even slightly, your mind is clouded by hope or fear. You are biased toward defending your current position, rather than objectively assessing the true movements of the market. You are no longer watching the tape. You are watching the fate of your own position. But cash demands pure objectivity. You are watching the movements, calculating the odds, and preserving your ammunition. Your capital is your army. You do not send your army into the field until the target is clearly identified, the path of attack is confirmed, and the probability of success is maximized. To throw capital into the market without a clear signal is akin to firing your cannons into the fog. It is a waste of resources and morale. The signal is the only license to move cash into the market. Until the market presents a proven high-probability setup, your capital must remain secured, ready to strike, but not exposed to unnecessary risk. I often held significant capital entirely out of the market for weeks, even months, following major movements. People would ask, "Aren't you missing opportunities?" My response was always the same. There is always opportunity, but my primary job is to protect my capital from the low-probability opportunities. A speculator's primary concern must be capital preservation, not maximization of daily trading volume. If you preserve your capital, the great opportunities, when they finally arrive, will find you fully prepared to exploit them ruthlessly. Holding cash allows you to capitalize on the panic and the certainty of others. When a crisis hits, the impulsive operators are already fully invested, paralyzed by their losses, and unable to take advantage of the sudden cheapness. They have no strategic reserve. The disciplined operator sitting on cash views the panic as a gift. He has the freedom and the resources to enter the market precisely when the risk-reward calculation becomes overwhelmingly favorable, when the signal, though driven by fear, is finally undeniable. Never forget this lesson. Cash is an active position. It is the position of patient power. It ensures objectivity and readiness. Never feel pressured to abandon this strategic position just because the market is fluctuating. Wait for the clear, confirmed, high-probability signal. A fundamental shift in mindset is required to move from the amateur ranks to the professional. The amateur wants to buy at the absolute low and sell at the absolute high. He strives for perfection in every tick. The professional accepts the inherent imperfection of timing. The successful speculator must be willing to pay the premium for certainty. What is this premium? It means accepting that the first few percentage points of a major move will be missed. You must be content to enter the trade after the first. Volatile shakeout is complete, and the direction is undeniable. Those missed points are the price you pay for confirmation. They are the insurance policy against the chaos of premature entry. They are the cost of minimizing risk. Consider a stock that is due to move from 50 to 100. The impulsive trader tries to buy at 50 and 1/8. He risks the entire move because he is buying before the signal is present. He is relying on foresight, not factual confirmation. The disciplined operator waits until the price has moved to, say, 55 and clearly established the line of least resistance. He pays the 5-point premium. He has missed the first 10% of the move. But what has he gained? He has gained certainty. He has reduced the probability of being stopped out prematurely to near zero. He knows that the major forces are now aligned in his favor. He has exchanged 5 points of potential profit for 50 points of high probability movement. This concept of the patience premium is often misunderstood as simply being late. It is not late. It is strategic timing. You trade only when the risk is minimized by the market proving its direction. When the market is uncertain, the risk is at its highest. When the market provides a clear signal, the risk relative to the potential reward drops dramatically. The speculative life is not about maximizing every possible dollar from the market. It is about maximizing the probability of success in every action taken. The amateur believes that if he misses the first 2 points, he has ruined the trade. The professional knows that if the move is genuine, those first 2 points are inconsequential. If the stock is truly moving 50 points, complaining about the first 2 is foolish. It is psychological preparation. You must consciously train yourself to ignore the initial burst of the price. Let the amateurs fight for those volatile early ticks. Let them panic. Let them settle the argument. When the market has resolved its initial conflict and established a clear path, then you enter, paying your premium for certainty. This discipline ensures that your focus remains on the larger movement, not the minor fluctuations. Always be willing to pay the patience premium. It is the cheapest insurance in the world of speculation. Most speculators focus exclusively on price. They see a price break a resistance level and immediately execute the order. They forget the second, equally crucial component of every genuine signal: time. A true signal often requires a significant amount of time to develop. It is not enough that the price touches a high. It must hold that high over a period that establishes credibility. I learned through painful repeated losses that great movements do not run their course in an hour or a day. They are massive forces, requiring significant structural adjustment in the market. This takes time. The impulse trader focuses solely on price. The disciplined operator focuses on the interplay of price and time. If a stock breaks out on a Monday morning, rushes up 5 points, and then falls back 2 points by closing time, that is not a strong signal. That is a transient event. The market moved, but it did not hold. The time element was insufficient to establish conviction. A genuine signal needs time to breathe, to consolidate, and to confirm. How long is enough time? There is no strict rule, but a critical price break that holds through a full day, or better yet, consolidates above the line for several days, carries infinitely more weight than a brief spike that immediately reverses. The time element acts as a psychological filter. It filters out the momentary enthusiasms, the short-lived rumors, and the manipulative thrusts designed solely to create superficial momentum. Only sustained conviction over time proves that the fundamental forces, the major pools of capital, the true shift in public sentiment, the underlying change in value, are driving the price. If the signal hasn't held long enough to establish credibility, ignore it. It is merely a noise on the tape. Think of it as setting concrete. You can pour the cement quickly, but it must be given time to set and cure before you can build a structure upon it. If you rush the building, the structure collapses. The speculator who ignores the time element of the signal is building his position upon wet cement. The market uses time to wear down the amateur. If the price moves to 55, stays there for 3 tedious days, and then begins to advance slowly, the amateur becomes bored or fearful and liquidates. He only saw the price move. He did not respect the time the market needed to accumulate and prepare for the true ascent. If you respect the time element, you develop patience beyond the immediate tick. You understand that the market is a colossal machine, and large movements require frictional energy and time to build momentum. Wait for the price to prove itself and wait for the position to hold firm. Price confirms direction, time confirms conviction. Never separate the two. Never under any circumstance anticipate a signal. Wait for its factual, undeniable presence. Anticipation is the act of predicting the future, which is impossible. The speculator's job is not to predict, but to observe and react to what the market is actually doing. Prediction is the realm of fortune tellers and uninformed tipsters. Observation is the realm of the professional. When you anticipate a signal, you are saying, I know what the market will do next. The arrogance of this position is usually punished swiftly. When you wait for the factual signal, you are saying, I will follow the market when it shows me the way. The signal is the market communicating its present status, that the path of least resistance has been established and is now inviting traffic. I spent my early years anticipating. I would see a stock falling and assume it must be near the bottom, trying to buy fractions off the absolute low. I lost fortunes doing this. I learned that there is no bottom until the market proves there is a bottom. The market, left to its own devices, will always follow the path of least resistance. That path might surprise you. It might defy all your fundamental analysis. But your analysis must be secondary to the tape's confirmation. If you anticipate a break upward, you buy prematurely. If the stock then reverses, you are immediately wrong, exposed, and forced to cut your loss. If you wait for the break upward to confirm itself through a sustained holding action, you are entering the market when the risk is managed. The market has done the hard work of proving the path. Your job is simply to follow the road that has already been paved. The speculative genius lies in patience, not prescience. If you find yourself saying, I think this stock is about to, stop immediately. Replace that thought with, I will act only when this stock does. The signal removes the guesswork. It eliminates the emotional strain of prediction. It provides a clean, objective trigger for action. Do not anticipate a movement because the circumstances seem right. The circumstances only become right when the market, through its actions, validates your thesis. The discipline required here is immense. You will watch hundreds of stocks that appear ready to move only to see them fail to deliver the signal. The amateur leaps into 20 of them, losing a fraction on each until his capital is depleted. The professional ignores 19 of them, waits for the one clear signal, and executes with full force, knowing his risk is managed by the market's confirmation. Trade the undeniable path. Never trade your hopeful anticipation. Impulsive trading is often a direct consequence of a recent loss. This is the revenge trading cycle, and it is the fastest route to ruin. The cycle begins with a legitimate, perhaps large, loss. The speculator feels wounded, his judgment is impaired, and his primary psychological driver becomes the immediate desire to make up the capital he just lost. This emotional state bypasses the need for a signal entirely. The speculator does not wait for a high probability setup. He scrambles for any setup, searching the tape for the first stock that shows the slightest movement, rationalizing the trade based on speed and the desperate need for recovery. He trades not because the market is offering an undeniable opportunity, but because his ego demands immediate financial retribution against the market. This is emotional gambling masquerading as speculation. The market is indifferent to your financial health, and it certainly does not care if you feel wronged. The market has no memory. But the speculator, driven by revenge, operates entirely in the past. The trade executed in a state of revenge is guaranteed to be impulsive, poorly researched, and oversized. The speculator is usually trading against his own established rules, increasing position size to recover the loss faster, or entering positions based on thin signals that he would normally ignore. The signal is the necessary intervention that breaks this cycle of reckless, emotionally charged retaliation. The hard rule must be established. No action can be taken until the market delivers an undeniable signal, regardless of recent losses. If you have just suffered a loss, your most crucial task is not to trade, but to step back. The emotion of the loss must dissipate entirely. Your mind must return to a state of cold, objective assessment. The requirement to wait for the signal forces this crucial delay. If the market is not presenting a high probability opportunity, you simply cannot trade, no matter how much you wish to recover the lost capital. If the revenge impulse takes hold, your response must be discipline. Is the signal confirmed? Has the market shown its hand? If the answer is no, you are compelled to remain sidelined. The speculator who attempts to fight the market, to get even, will inevitably find the market handing him a heavier beating. Recovery from a loss is achieved through discipline and patient accumulation of profitable trades based on confirmed signals, not through desperate lunges into the next stock that twitches on the tape. Let the emotional wound heal. Wait for the signal. The signal is your shield against yourself. Without it, the market will exploit your psychological weakness relentlessly. This is perhaps the hardest lesson for the professional speculator to master, yet it is the most vital for long-term survival. There will be days, weeks, even months where no reliable signal appears. The market drifts sideways. The price movements are choppy, directionless, and treacherous. The volatility is high, but the conviction is low. The highest form of discipline is the ability to stand aside and do nothing. The desire to trade, the constant craving for action, the feeling that you are wasting time if you're not actively positioned, is a powerful force. It is the amateur mindset at its most insidious. Your job is not to trade every day. Your job is not to generate daily income. Your job is to preserve capital and capitalize only on high probability opportunities when the signal is undeniable. If the market is ambiguous, if the price action lacks clarity, if the forces of supply and demand are balanced, your place is on the sidelines. The successful speculator is paid handsomely for patience. He might make the majority of his annual profit during 2 or 3 sustained, clear movements, while spending the rest of the year preserving capital and waiting. The amateur, attempting to generate steady income, trades every day. He loses small fractions repeatedly in the chop, or he is shaken out by false moves. When the great, clear movement finally appears, he has depleted his capital, ruined his nerve, and is unable to participate fully. Standing aside is an active decision. It is the decision to ignore the noise and conserve your resources. This rule demands incredible humility. It means admitting, often for long periods, that you do not know what the market is doing, and therefore you will not risk capital on guesswork. The impulsive trader fears missing the movement. The disciplined operator fears unnecessary loss of capital. If the tape does not speak clearly, do not interrupt its silence with your trades. The market provides signals for movement. If it fails to provide those signals, it is issuing a warning. Stand aside. Heed that warning. I spent countless days simply watching the tape, doing nothing, yet fully engaged. I was learning. I was observing the behavior of prices under various conditions. That observation, without the distortion of an open position, was immensely profitable in the long run. Never force a trade. If the signal is absent, stand aside. It is the ultimate test of discipline over desire. Capital preserved in the doldrums is capital ready for the hurricane of opportunity. Your success in the market hinges on one fundamental truth. Impatience is the tax levied on the amateur. You must accept this cost, or you will forever pay it with your capital. You are not an amateur. From this moment forward, you are a disciplined architect of opportunity. You are an observer of facts. You are a follower of the line of least resistance. You wait for the proven signal, or you do nothing at all. You accept the patience premium. You ignore the hunch. You secure your cash as a strategic reserve. You reject the impulse to recover losses immediately. You will allow the market to prove its direction, holding its ground in both price and time before you commit a single dollar. Discipline is the only currency the market truly accepts. Master the weight and you master speculation itself.
Welcome to Wix Harmony. Take the speed of AI and pixel-level control to go from words into a full website that's entirely yours to shape. Need a new page, section, or a restyle? Ask Aria, your personal AI agent. And boom, there it is. Flow naturally between generating and doing it yourself. This is the new way to create Wix Harmony.
Hi, I'm Sam, founder and CEO of Manifest. With 2.5% cash back on purchases of $5,000 or more and unlimited 2% cash back on all other purchases, we can launch more breakthrough products.
The Inc. Business Premier Card from Chase for Business. Make more of what's yours.
Listen to me carefully. Right now, as you're watching this, somewhere in the world a trader just lost everything. Not because they were stupid, not because they didn't work hard, but because they committed the one sin that the market never forgives. They entered at the wrong time. I've seen it happen 1,000 times. I've watched fortunes evaporate in hours because someone thought they could outsmart the tape. They couldn't, and neither can you, unless you understand what I'm about to tell you. The market doesn't care about your analysis. It doesn't care about your indicators. It doesn't care about the money you need to pay your bills. The only thing that matters is timing. Master it, or keep bleeding money until there's nothing left. I'm going to show you exactly how the professionals time their entries, and why everything you've been taught is probably setting you up for disaster. You want to know the real reason most traders fail? It's not lack of knowledge. It's not even lack of discipline, though that's part of it. The real reason is that they're playing a game they don't understand with rules nobody ever explained to them. They're taught to buy low and sell high, as if the market has a sign that says, this is low and this is high. They're told to follow trends, but nobody tells them how to identify when a trend is about to reverse and trap them. They learn about support and resistance, then watch in horror as those levels get smashed through like they were made of paper. I should know. I've made millions and lost millions, and the difference between the two always came down to one thing: timing. When I was young, I thought I was clever. I'd watch a stock move up and I'd think, it's gone up too much, time to short it. Or I'd see a stock falling and think, it's gotten too cheap, time to buy. You know what happened? I got destroyed, over and over again, because I was fighting the market instead of reading it. The market was telling me exactly what it was going to do, but I was too arrogant to listen. I was imposing my opinion on price action instead of letting price action guide my decisions. That's what kills traders. Their ego, their need to be right, their stubborn belief that they know better than the collective wisdom of millions of participants putting real money on the line. Here's what changed everything for me. I stopped trying to predict where the market should go and started observing where it was actually going. I stopped fighting obvious moves because they seemed too extended and started riding them. I learned that the market can stay irrational longer than you can stay solvent, and that trying to pick tops and bottoms is a fool's game. The money isn't made by being contrarian for the sake of it. The money is made by recognizing when the market is in motion and positioning yourself in alignment with that motion at exactly the right moment. Not too early, not too late, but at that precise point where probability shifts dramatically in your favor. Think about it like this. Every major move in the market goes through distinct phases. First, there's accumulation or distribution, where the smart money is quietly positioning itself while most people aren't paying attention. Then there's the markup or markdown phase, where price starts to move in a clear direction. This is followed by the public participation phase, where everyone notices the move and jumps in. Finally, there's the climactic phase, where the move exhausts itself and reverses. Now, where do most traders enter? They enter during the public participation phase, or worse, during the climactic phase, right before the reversal. They're buying tops and selling bottoms because they're reacting to what's already obvious instead of positioning themselves ahead of the obvious. The professionals do the opposite. They're accumulating when nobody's watching. They're building positions during those boring sideways markets that put everyone else to sleep. They're entering when the technical setup is perfect, but before the move has attracted attention. Then, when everyone else is piling in late, they're already sitting on substantial profits and preparing to exit. This isn't insider trading. This isn't manipulation. This is simply understanding market psychology and timing your entries to align with where institutional money is flowing rather than where retail traders are rushing. Let me tell you about a dollar trade that taught me this lesson in the most painful way possible. It was cotton. I'd done my research, and I was convinced cotton was going higher. I was right about the direction, dead right, but I was wrong about the timing. And in trading, being right at the wrong time is the same as being wrong. I entered too early. The market wasn't ready to move yet. For weeks, my position just sat there, bleeding me through small losses and opportunity cost. I watched other opportunities pass by because my capital was tied up in a position that was going nowhere. Finally, I couldn't take it anymore and closed the position for a loss. And you know what happened next? Cotton exploded higher, exactly as I'd predicted. The move was there. The opportunity was real, but my timing was off. And that made all the difference between a massive win and a frustrating loss. That experience taught me something crucial. The market doesn't reward you for being right in theory. It only rewards you for being right in practice, at the right time, with the right position size. You can have the best analysis in the world, but if you enter before the market is ready to move, you'll either get stopped out for a loss or watch your capital sit dead while better opportunities pass you by. Timing isn't just important, it's everything. It's the difference between consistent profits and constant frustration. It's the difference between growing your account and watching it slowly bleed away, through death by 1,000 cuts. So, how do you develop this timing? How do you learn to enter at the point of maximum probability and minimum risk? It starts with understanding that price action tells you everything you need to know, not your indicators, not your oscillators.
This is my team, and we get everything done with Monday.com. Sarah is a senior project manager, and she has never missed a deadline. She uses Monday.com so every project she leads goes from A to Z in record time. Seriously, she makes us all look like clowns. She made a pre-made template for project management. She calls it her golden workflow. Now all stakeholders are aligned, timelines are clear, and all work lives in the same place.
But what if there's no template for what we need?
Glad you asked, Marcus. Meet Sarah's AI savior, Monday Sidekick. She writes what she needs, and within moments, her custom workflow is ready to roll. Either way, now the whole team finishes projects before you can even say, try Monday.com for free and get more done.
How can I boost digital brand visibility? Introducing SEMrush One, uniting traditional SEO and AI search tools, all in one place. Measure and grow everywhere you're discovered. One solution to win every search.
Not your complex algorithms, price, pure, simple price movement. When I look at a chart, I'm not looking at what I think should happen. I'm looking at what is happening right now. I'm observing how price is behaving at key levels. Is it respecting support and resistance? Or is it slicing through them? Is volume confirming the move? Or is price moving on thin air? Are we seeing climactic volume that suggests exhaustion, or steady accumulation that suggests smart money positioning? The best entry points share common characteristics. They occur at moments of transition, when the market shifts from one state to another. Think about it. When does a stock that's been in a downtrend finally bottom? It doesn't just turn on a dime out of nowhere. First, you see the downward momentum begin to slow. The selling waves become less severe. Then you see a test of the lows where price holds, creating a double, bottom, or some other reversal pattern. Volume often spikes on this test as sellers exhaust themselves. Then, and only then, do you see the first signs of buying pressure. Price starts to hold above short-term moving averages. It starts to make higher lows. The character of the market changes from sellers in control to buyers stepping in. That transition point, that shift in character, that's where the professional enters. Not at the bottom, not after the move is obvious, but right at that inflection point where probability shifts. The same principle applies to breakouts. Most traders chase breakouts after they've already happened. They see a stock breaking above resistance with a big green candle, and they jump in, eager to catch the move. You know what happens next? The stock reverses, and they're caught in a bull trap. Why? Because they entered after the move, not before it. The correct way to play breakouts is to position yourself before the breakout occurs, when price is consolidating just below resistance, building energy like a coiled spring. You watch for volume to dry up, indicating that sellers are exhausted. You watch for price to hold higher and higher lows within the consolidation, indicating accumulation. Then, when you see those first signs of buying pressure beginning to expand, that's when you enter, before the breakout, not after it. Your risk is clearly defined. If price breaks back into the consolidation, you're wrong and you exit. But if you're right, you catch the entire move from the beginning, not just the exhausted end of it. This is what separates professionals from amateurs. Amateurs react to what's already happened. Professionals anticipate what's about to happen based on how price is setting up. Amateurs chase momentum after it's obvious. Professionals position themselves ahead of momentum, then let the crowd chase the move and provide their exit liquidity. Amateurs enter based on hope and excitement. Professionals enter based on calculated probability and clear risk management. The difference in results is staggering. One group slowly loses money through poor entries and bad timing. The other group consistently profits by entering at points where risk is minimal and potential reward is substantial. Now, I know what you're thinking. This all sounds great in theory, but how do you actually identify these perfect entry points in real time? How do you know when the market is truly shifting versus when it's just a false move that will reverse and trap you? That's the million-dollar question, isn't it? And the answer is experience combined with systematic observation. You need to develop a sense for market rhythm, for the ebb and flow of price action. You need to watch thousands of setups form and play out so your mind begins to recognize the patterns intuitively. But more than that, you need a framework, a systematic way of evaluating whether a setup meets your criteria or not. Here's mine, and you can adapt it to your own style. First, I never enter a trade unless the broader market context supports the move. If I'm looking at a long setup, I want to see the overall market in a bullish phase, not fighting against a bearish tide. Going against the market trend can work, but it dramatically reduces your probability of success. So why fight with one hand tied behind your back? Second, I want to see clear evidence of accumulation or distribution at key levels. This shows up in volume patterns, in how price behaves at support or resistance, in the character of the candlesticks or bars. Third, I want a clear catalyst or technical trigger that will likely attract other buyers or sellers. This could be a breakout above a key level, a successful test of support, a moving average cross, or any number of technical triggers that tend to attract attention and create momentum. Fourth, I want clear risk definition. I need to know exactly where I'm wrong, and that level needs to be close enough that my risk is acceptable relative to my potential reward. If I can't define a clear stop-loss level that makes sense, I don't take the trade, period. When all four of these factors align,
save time creating content and generate a high-quality clone of your voice with 11 Labs. Change the way you record podcasts, voiceovers, and branded content with the #1 AI-powered voice-generating technology. Stop searching for the perfect voice and stop wasting time re-recording take after take. Try 11 Labs for free and start elevating your content today.
H&R Block makes it easy to reserve time for your taxes. Tap us in, Find a time that works for you, upload your docs ahead of time, and track your return from start to finish. It's all in the MyBlock app. Get started at hrblock.com.
That's when I strike, not before. I don't take trades because I'm bored or because I feel like I should be doing something. I wait patiently for these high probability setups where all the factors line up in my favor. This means I'm not always in the market. In fact, I'm out of the market more than I'm in it. I'm watching, observing, waiting for that perfect pitch. And when it comes, I swing hard. This is how you compound wealth in the markets, not by trading constantly, not by staying busy, but by waiting for those moments where the odds are stacked heavily in your favor, then committing capital with conviction. Most traders do the opposite. They take marginal setups, constantly because they can't stand being on the sidelines. Then they wonder why their results are mediocre at best. Let me give you a modern example that illustrates these principles perfectly. Think about how the big tech stocks moved during the various bull and bear markets of the past decade. Time and time again, you'd see the same pattern play out. A stock would go through a correction, pulling back to a key moving average or support level. The financial media would run negative stories. Retail traders would panic and sell. Then, you'd see the stock begin to hold at that support level. Volume would spike on down days, but price wouldn't break lower. Then, suddenly, you'd see a reversal day with strong volume and price closing near the highs. That was your signal. That was the market telling you that institutional buyers were stepping in, absorbing the selling, and preparing to mark prices higher. The traders who entered at that point, when it was still uncomfortable and uncertain, made fortunes. The traders who waited for confirmation, who wanted to see several days of strong upside before they believed the move was real, entered late and often got caught in the first pullback. This same pattern repeats across all time frames, in all markets, throughout history. Human psychology doesn't change. Fear and greed don't change. The patterns that work today are the same patterns that worked when I was trading 100 years ago, and they'll be the same patterns that work 100 years from now. The specific indicators might change. The technology might evolve. But the underlying dynamics of how markets move from equilibrium to momentum and back to equilibrium, those are eternal. Master those dynamics. Master the timing of entries and exits within those dynamics, and you have a skill that will serve you for life. But here's where most traders go wrong. Even when they understand these concepts intellectually, they know they should wait for high probability setups. They know they should enter at inflection points rather than chasing moves. But in the heat of the moment, when they're watching a stock rocket higher without them, they abandon their discipline. They can't stand the pain of missing out, so they chase. They enter at exactly the wrong time, driven by emotion rather than logic. Then, when the inevitable pullback occurs, they panic and sell, locking in a loss. This cycle repeats over and over, and they never break free because they never develop the emotional control necessary to stick to their plan. Trading success isn't about having more knowledge than the next person. By now, the basics of technical analysis are available to anyone with an internet connection. The information isn't secret. The patterns aren't hidden. What separates winners from losers is emotional discipline, the ability to follow your rules even when every fiber of your being wants to break them, the ability to sit on your hands when there's no good setup, even though you're bored and eager to trade, the ability to take your profits when your plan says to exit, even though the position might go further in your favor, the ability to cut your losses quickly when you're wrong, even though admitting defeat is psychologically painful. These are the skills that matter. These are the skills that determine whether you survive and thrive or blow up your account and quit. And here's the thing nobody tells you. Developing these skills takes time. It takes screen time, watching markets day after day, month after month, until the patterns become second nature. It takes real money on the line, because paper trading doesn't create the emotional pressure that reveals your psychological weaknesses. It takes losses, painful losses, that teach you what not to do. Every successful trader has blown up at least one account. Every successful trader has made every mistake in the book. The difference is that they learned from those mistakes instead of repeating them endlessly. They developed the mental database of what works and what doesn't through painful experience, and they used that knowledge to refine their approach until it became consistently profitable. So when I tell you that timing is everything, I'm not just talking about the mechanical aspect of identifying entry points. I'm talking about the entire package: the market awareness, the pattern recognition, the emotional discipline, the risk management, the patience to wait, and the courage to act when the moment arrives. All of these elements work together to create what looks like perfect timing from the outside. But it's not luck. It's not some innate gift. It's a skill developed through dedicated practice and painful lessons, and it's available to anyone willing to put in the work and pay the tuition the market demands. The question you need to ask yourself is this: are you willing to do what it takes? Are you willing to study charts for hours, not just looking for setups, but truly observing how price behaves in different conditions? Are you willing to keep a detailed trading journal, recording every trade, every emotion, every deviation from your plan, so you can identify your patterns and correct them? Are you willing to risk real money, knowing you'll lose some of it in the process of learning, but viewing those losses as tuition rather than failures? Are you willing to sit on your hands for days or weeks waiting for the right setup, even though it's boring and you feel like you should be doing something?
Your perfect domain is out there. Go to Wix and make it yours. Claim your space online. Own your name, your brand, your breakthrough. And the rest just clicks. It all starts with a domain. What's yours?
Are you looking to establish your business using an address other than your home? Well, at iPostal One, we can help with that. You took the leap and started your own company. Great. But you don't want to use your home address to register your business. It's unprofessional and unsafe, but you already know that. At iPostal One, you can get a real physical street address. Choose an address from thousands in our network and immediately upgrade your brand image and protect your privacy. Unlike a P.O. box, you can also use it with your business registration. We receive your mail and packages, and all you have to do is view and manage them with our app or online. It's as easy as that. Upgrade your business image and mail experience today with a digital mailbox from iPostal1.com.
If you can answer yes to these questions, if you can commit to this path, then you have a chance. If not, save yourself the pain and find something else to do with your time and money. I've given you the foundation. I've explained how market timing actually works, why it's crucial, and what separates good timing from bad. But understanding these concepts intellectually is just the beginning. Now comes the hard part. Now comes the implementation, the practice, the grinding work of developing this skill through repeated exposure to real market conditions. There are no shortcuts. There are no magic indicators that will do this for you. There's just you, the market, and the choices you make in the moment. Choose wisely. Choose based on probability rather than emotion. And you'll give yourself a fighting chance. Choose poorly. Let your emotions drive your decisions, and you'll join the vast majority of traders who never make it past their first year. The market is waiting. It doesn't care whether you succeed or fail. It will present opportunities to those who are prepared to see them and seize them at the right moment. It will punish those who enter at the wrong times, who chase moves out of fear of missing out, who let hope and denial keep them in losing positions too long. The choice is yours. But make no mistake, if you don't master timing, you will keep losing money. That's not a threat. It's a simple statement of fact, proven over and over throughout market history. The question isn't whether timing matters. The question is whether you're willing to do what it takes to master it. And that answer will determine everything about your future as a trader. Now let me take you deeper into the mechanics of timing, because understanding the concept is one thing, but executing it consistently is another beast entirely. You see, most traders approach timing like it's a binary decision, either you're in or you're out. But that's not how professionals think about it. We think in terms of zones, of building positions gradually as evidence accumulates that we're right, and reducing positions gradually as evidence accumulates that the setup is failing. This concept of scaling is critical to proper timing, yet it's almost never discussed in trading education material because it doesn't fit neatly into the simplistic buy here, sell there narrative that beginners want to hear. Think about how institutional traders operate. They're not putting their entire position on in one shot at one price level. They can't. Their size is too large. If they tried to buy 10 million shares at the market, they'd move the price against themselves before they filled half the order. So what do? They accumulate gradually. They build a position over hours, days, or even weeks, buying dips, absorbing supply, never showing their full hand to the market. Then, when they're fully positioned and ready for the markup phase, they step aside and let momentum traders chase the move higher, providing liquidity for their eventual exit. This is the game within the game, and if you don't understand it, you're playing checkers while everyone else is playing chess. As a retail trader, you have advantages that institutions don't have. You can move in and out of positions instantly. You can change your mind and be completely flat within seconds. You don't have to worry about moving the market with your orders. But most retail traders squander these advantages by acting like day traders on cocaine, jumping in and out of positions on a whim, never giving good setups time to develop, never building positions strategically. They treat trading like a video game where the goal is to make as many trades as possible, when in reality, the goal is to make as much money as possible, which usually means making fewer, better trades. Here's how I think about scaling into positions. When I identify a high probability setup that meets all my criteria, I don't immediately put my full position size on. I start with a pilot position, maybe 1/3 to 1/2 of my intended full size. This is my test. I'm dipping my toe in the water to see how price responds. If I'm right, and price immediately starts moving in my favor, I'll add to the position on the first pullback, increasing my size as my confidence grows and my size. Initial entry becomes profitable, giving me a cushion. If I'm wrong and price goes against me, I'm only risking a fraction of what I would have risked if I'd gone all in immediately. This approach does two critical things. It reduces my risk on trades that don't work out, and it improves my average entry price on trades that do work out. Over hundreds of trades, this single technique can be the difference between marginal profitability and substantial returns. The key to making this work is having clearly defined levels where you'll add to your position and clearly defined levels where you'll abandon the setup entirely.
CRM is so slow. So slow. Thank goodness I'm using Monday CRM.
Green, this report's taking forever. What a nightmare.
You know that with Monday CRM, you can create a dashboard super fast.
I don't have time for your daydreams. I gotta present this in 30 minutes.
Monday CRM is all about doing stuff faster. You can create a dashboard with real-time data, customize it, and make it real pretty in no time.
I'm using the biggest force in the game, and Kelly over here thinks Monday CRM's better.
Okay, stay slow. That's your problem.
Wait, are you serious? Can you really customize stuff without an admin?
Sure, you can customize anything you want by yourself, not just dashboards. Change the labels, text, and colors, add any deal stage you want, create new automations to save time. Speed is the name of the game.
And let me guess, you use AI also.
AI isn't just a buzzword. I use it for so many things, like generating mass emails, summarizing meetings and action items, and prioritizing my deals.
But moving to a new CRM will take forever.
Will it?
Did you just onboard me to Monday CRM with the snap of your fingers?
That's exactly what I did. Monday CRM. Do it faster.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI creation platform. Describe what you want, and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation, where you can go as far as your imagination takes you. Can you imagine it? Let's make your dream a reality right now.
You can't just wing it. You need a plan before you enter, and you need the discipline to follow that plan regardless of how you feel in the moment. Let's say you're looking at a breakout setup. Your initial entry might be on the first test of the breakout level with strong volume, while price is still within the consolidation. Your add point might be on a successful retest of the breakout level as new support. Your stop loss is below the consolidation, meaning if price breaks back into the range, you're wrong and you exit the entire position. Your profit target might be the measured move from the consolidation or a key resistance level above. Having this plan written down before you enter means you don't have to make emotional decisions in real time. You just execute the plan mechanically. This brings up another crucial aspect of timing that nobody talks about: the timing of your exits. Everyone obsesses over entries because that's the exciting part. But the truth is that your exit determines your profit or loss, not your entry. You can enter at a mediocre price and still make money if you exit well. You can enter at a perfect price and still lose money if you exit poorly. Yet most traders spend 90% of their time thinking about entries and 10% thinking about exits, when it should be closer to 50-50, or even weighted toward exits. There are 3 types of exits you need to plan for before you enter any trade. First, your stop-loss exit where you're wrong and need to cut the position to prevent further damage. Second, your profit target exit where you've achieved your objective and it makes sense to take the money and move on. Third, your trailing stop exit where the trade is working beyond your initial expectations and you want to let profits run while protecting gains. Most traders only think about the first one, and even then, they often move their stops or remove them entirely when price approaches, turning what should be small losses into disasters. Your stop-loss placement is actually a timing decision, not just a risk management decision. Where you place your stop tells you something important about your entry timing. If you have to place your stop very far from your entry to avoid normal market noise, that's a red flag that you're entering at a suboptimal time. The best entries allow for tight stops because you're entering at an inflection point where price should immediately start moving in your favor if you're right. If you need a wide stop, you're probably entering in the middle of a move rather than at the beginning of one, and that's a timing error. I learned this lesson the hard way, watching small losses turn into big losses because I entered at wrong times with wide stops, hoping the market would eventually come back my way. Hope is not a strategy. Tight stops at logical levels are a sign that your timing is good. Profit targets are trickier because you never know how far a move will go. A move that looks extended and ready to reverse can keep going for days or weeks. A move that looks like it's just getting started can stall and reverse without warning. This is where most traders torture themselves, exiting too early and watching profits evaporate, or holding too long and watching profits turn into losses. The solution is to have a systematic approach. I typically take partial profits at my initial target, maybe half my position, then trail a stop on the remainder to let it run if the move continues. This way, I'm guaranteed to capture some profit if I'm right, but I'm also positioned to capture extraordinary profits if I'm really right. It's a compromise, but it's a compromise that works over many trades. The trailing stop is your friend if you use it correctly. It allows you to stay in winning trades while protecting accumulated profits. But you can't trail too tightly, or you'll get shaken out on normal volatility. You can't trail too loosely, or you'll give back too much when the trade finally reverses. I typically trail based on market structure supporting my stop to below recent swing lows on an uptrend, or below major moving averages that have been respected throughout the move. The exact technique matters less than having a technique and following it consistently. What kills traders isn't the technique itself, It's the abandoning of the technique when emotions take over. Let me tell you about the concept of market rhythm, because this is fundamental to timing, and it's something you can only learn through experience. Every market has a rhythm, a characteristic way it moves based on the participants involved and the time frame you're trading. The stock market has a different rhythm than the commodity markets. Individual stocks have different rhythms based on their liquidity and volatility. Even the same stock will have different rhythms in different market conditions, a tight, choppy rhythm during consolidations and a smooth, trending rhythm during strong moves. Learning to feel this rhythm is essential to good timing. When you're in sync with the market's rhythm, trading feels easy. Your entries work. Your exits make sense. You can sense when to be aggressive and when to be defensive. When you're out of sync with the market's rhythm, everything is hard. You're constantly getting stopped out. Your entries immediately go against you. Your exits are either too early or too late. This is usually a sign that market conditions have changed and your approach needs to adjust. Maybe the market has shifted from trending to choppy, or from low volatility to high volatility.
Search has changed. Introducing SEMrush One, uniting traditional SEO and AI search tools, all in one place. Measure and grow everywhere you're discovered. Spot competitive gaps and audit for AI readiness. One solution to win every search.
With April 15th coming, doing your own taxes doesn't have to be intimidating.
Meet H&R Block online. Just drag and drop last year's return, then follow the clear step-by-step instructions. And if you need it, expert help is just a click away.
Beat the April 15th deadline at hrblock.com.
And the techniques that worked last week don't work this week. Recognizing these shifts quickly and adjusting your approach is another form of timing that separates professionals from amateurs. One of the most important rhythm shifts to recognize is the transition from a choppy, range-bound market to a trending market. In choppy markets, the best approach is to fade extremes, sell near the top of the range, buy near the bottom of the range, take quick profits. But if you continue this approach when the market breaks into a trend, you'll get destroyed. You'll be shorting the top of the range just as it breaks higher, or buying the bottom of the range just as it breaks lower. You need to recognize the breakout quickly, admit you're on the wrong side, flip your position, and ride the trend until it shows signs of exhaustion. This takes mental flexibility that most traders don't have. They get locked into one view of the market and can't adjust when conditions change. The opposite transition is equally important, recognizing when a trending market is shifting into a choppy, range-bound market. This is where trend followers get killed. They've been making money riding the trend, so they keep trying to buy dips or sell rallies, expecting the trend to continue. But now those dips and rallies are just moves within a range, and they're entering at exactly the wrong times, buying the top of the range and selling the bottom of the range. They give back all their profits and more because they can't recognize that the game has changed. The key is to notice when the character of the price action changes, when momentum starts to wane, when breakouts start to fail, when the market stops making progress in the direction of the trend. These are signs that it's time to shift strategies or step aside entirely. Stepping aside is itself a timing decision, and it's one that most traders never make consciously. They feel like they should always be in a position, always have something working, because otherwise they're not really trading. This is a fundamental misunderstanding of what professional trading is about. Professional trading is about deploying capital when conditions are favorable and sitting on your hands when they're not. It's about recognizing that there are times when the market is offering high probability opportunities and times when it's not, and adjusting your activity level accordingly. The best traders I've known spent the majority of their time waiting, not trading. They were patient predators, conserving energy, watching for that perfect moment to strike. When it came, they committed fully. Then they went back to waiting. This patience is unnatural for most people. We're wired to want constant action, constant stimulation, constant progress. The market exploits this tendency mercilessly. It rewards patience and punishes impulsiveness. It rewards those who can sit through boredom and uncertainty, waiting for their pitch. It punishes those who need constant action and trade just to feel like they're doing something. If you can't develop this patience, you need to find a different way to make money, because trading will systematically extract wealth from you through 1,000 small impulsive decisions that seem insignificant in the moment but add up to substantial losses over time. Here's another timing principle that took me years to learn. The best time to trade is when you don't need to trade, when you're desperate, when you need to make money to pay bills or recover losses. Your timing will be terrible. You'll force trades that aren't there. You'll hold losers too long hoping they'll come back. You'll exit winners too early because you need to lock in profits. You're trading from a position of weakness, and the market can smell weakness. Conversely, when you're patient, when you have capital available but feel no pressure to deploy it, your timing improves dramatically. You can wait for the perfect setup. You can let profits run. You can cut losses quickly without emotional attachment. You're trading from a position of strength, and that strength translates into better decisions and better results. This is why proper position sizing is actually a timing tool. If your positions are too large relative to your capital, every normal market wiggle becomes emotionally charged. You can't think clearly. You can't execute your plan. Your timing falls apart because you're too scared or too excited. But if your positions are appropriately sized, where a stop loss is disappointing but not devastating, you can remain objective. You can execute your plan. Your timing improves because you're not trading from emotion. Most traders blow up not because their analysis was wrong, but because their position size was too large, causing them to make emotional timing errors they never would have made with properly sized positions. Let me share with you one of the most valuable timing techniques I've ever learned, and it's so simple that most traders dismiss it. Before you enter any trade, ask yourself, can I afford to be wrong? Not financially, we've already covered position sizing. I mean mentally and emotionally. If this trade goes against you, will you be able to cut the loss cleanly and move on? Or will you be so attached to being right that you'll hold and hope and eventually turn a small loss into a disaster? If you can't honestly say that you'll take the loss without drama, don't enter the trade. Your timing is already compromised by your emotional state. Wait for a setup that you can approach objectively, where you genuinely don't care whether it works or not because you've got 10 more setups waiting. That detachment, that emotional neutrality, that's when your timing is at its best. This principle extends to scaling out of positions as well. Most traders struggle with taking profits because they're afraid of being wrong, afraid of exiting too early, and missing out on additional profits, gains. This fear compromises their exit timing.
Welcome to the new generation of web creation, where words can launch a business, while you control every detail. The generation always adapting, without missing a beat. It's your generation, where vision and technology work as one. This is the new way to create. Wix.
Make a move with Hostinger Self. Bring your idea to life with Hostinger Horizons AI. You just need to describe it. Sign up for a 1-year plan and get up to 2 months for free. Create powerful websites and apps without writing a single line of code and go live with 1 click. Now for less than half of a streaming subscription. Try for 30 days without risk. Join more than 4 million people going online with Hostinger. Turn one day into day one with AI website and app creation. Go for it at hostinger.com.
They hold positions too long, watching profits shrink or disappear entirely because they can't pull the trigger. The solution is to remove the emotional weight by taking partial profits. Once you've locked in some gain, you've already won. Now you can let the rest run with a clear mind, or you can exit the remainder at any point without regret. This technique of taking partials transforms your psychology around exits, which directly improves your timing. The cumulative effect of all these timing decisions, your entry, your position sizing, Your ads, your partial exits, your trailing stops, your final exits determines your overall trading results. Two traders can have the exact same setups, the exact same market read, but completely different results based purely on the timing of their execution. One enters too early and gets shaken out before the move begins. The other enters at the optimal point and rides the entire move. One sizes too large and exits from fear. The other sizes appropriately and executes the plan flawlessly. These timing differences compound over hundreds of trades to create massive divergences in outcomes. This is why you can't just copy someone else's trades and expect to get their results. The timing of every decision matters, and that timing comes from your own psychology, your own experience, your own discipline. So when someone asks me what the secret to trading success is, I don't talk about indicators or strategies or market theories. I talk about timing. I talk about developing the skill to recognize when probability is in your favor and the discipline to act on that recognition. I talk about the patience to wait for these moments and the courage to commit when they arrive. I talk about the mental flexibility to adjust when conditions change and the emotional control to execute your plan regardless of fear or greed. These are timing skills, all of them, and they're far more important than any technical pattern or indicator you could ever learn. Master these, and you'll make money in any market, with any approach. Fail to master these, and it doesn't matter what strategy you use, you'll keep losing money until you either quit or finally learn what I'm teaching you right now. Now, I want to address something that's probably been nagging at you this entire time. You're thinking, this all sounds great, but how do I actually practice these timing skills? How do I develop this intuition without blowing up my account in the process? That's a legitimate question, and it's one that deserves a thoughtful answer, because the learning curve in SASPIT, trading is brutal and expensive if you approach it wrong. Most traders treat their live account like a video game, taking random trades, learning nothing from their losses, and eventually quitting when their money runs out. There's a better way, but it requires structure and discipline. 2. Qualities most traders lack. First, you need to start with observation, not participation. Before you risk a single dollar, you need to spend time watching markets, recording potential setups, and tracking how they play out. I'm not talking about paper trading where you pretend to take trades and pat yourself on the back for pretended profits. I'm talking about genuine market observation where you identify setups, note what makes them attractive, predict how they'll play out, and then watch without any emotional stake in the outcome. Do this for several months, and you'll start to build a mental database of what works and what doesn't. You'll see patterns emerge. You'll notice that certain setups work in certain conditions and fail in others. You'll develop a sense for market rhythm without risking any capital. This is the foundation. Once you've done this groundwork and you have a clear edge that you've documented through observation, then and only then should you start trading with real money. But start small, ridiculously small. Small enough that a loss doesn't bother you emotionally at all. Why? Because you're not trying to make money at this stage. You're trying to execute your plan flawlessly while money is on the line. You're trying to discover the psychological differences between watching a trade and being in a trade. You're trying to identify the emotional patterns that cause you to deviate from your plan. If you start with large positions, you'll be too emotional to learn anything. You'll just repeat the same mistakes over and over because you're in survival mode rather than learning mode. Keep a detailed journal of every trade, not just the entry and exit prices, but your thought process. What made you take the trade? What was your plan? How do you feel during the trade? Where did you deviate from your plan, if at all? What would you do differently? This journal is more valuable than any trading book you could read because it's a record of your own psychology, your own patterns, your own edge taking shape. Review it weekly. Look for patterns in your behavior. Are you consistently exiting winners too early? Are you holding losers too long? Are you entering before your setup is complete because you're impatient? These patterns will reveal themselves if you're honest in your journaling, and once you see them clearly, you can work on correcting them. The hardest part of this process is being honest with yourself. It's so tempting to rationalize bad trades, to make excuses, to blame the market or bad luck or some external factor. But the market doesn't care about your excuses. Either you're making money or you're losing money. And if you're losing money, something in your approach needs to change. The traders who succeed are the ones who can look at their results objectively, identify their weaknesses brutally, honestly, and systematically work to correct them. The traders who fail are the ones who keep making the same mistakes, blaming external factors, convinced that eventually luck will turn their way. It won't. The market isn't random. It rewards skill and punishes mistakes consistently over time. Another crucial aspect of developing timing skills is specialization. Most traders try to trade everything: stocks, futures, forex, crypto, all at once. They jump from strategy to strategy, time frame to time frame, market to market, never developing deep expertise in anything. This is a recipe for mediocrity at best. The best traders I've known specialized ruthlessly. They picked one market, one strategy, one time frame, and they became absolute experts in it. They could sense subtle shifts in their chosen market that others couldn't see. They knew how their market behaved in different conditions because they'd watched it obsessively for years. This deep specialization gave them a timing edge that generalists could never match. Think about it logically. If you're trying to track 20 stocks across 3 time frames using 4 different strategies, how can you possibly develop the deep pattern recognition necessary for excellent timing? You're spread too thin. You're constantly context switching. You never develop that intimate feel for how your market moves. But if you focus on 3 stocks that you watch every single day, studying their behavior, noting how they react to news and market conditions, observing the patterns that repeat, you'll develop an edge in those 3 stocks that's real and sustainable. You'll start to sense when something is off, when the rhythm has changed, when an opportunity is forming. This is the kind of edge that matters, and you can only develop it through focused, specialized observation over time. This principle of specialization applies to time frames as well. Day trading requires completely different skills and psychology than swing trading, which is completely different from position trading. The patterns are different. The risk management is different. The mental demands are different. Trying to do all 3 simultaneously is like trying to be a professional sprinter, marathoner, and powerlifter at the same time. Pick one, master it. Then, if you want to expand, you can add another time frame or strategy. But trying to do everything at once is why most traders never achieve consistency in anything. Let's talk about the role of technology in timing, because this is where a lot of modern traders get seduced by false promises. They think that if they can just find the right indicator, the right algorithm, the right automated system, they won't have to develop these skills themselves. The machine will do it for them. This is a fantasy. I'm not saying technology is useless, far from it. Good charting software, reliable data feeds, fast execution.
You can hide from your boss, but you can't hide your 1099 DA from the IRS. We align your 1099s with your actual history.
Are you using your home address for business but know it's hurting your brand image? At iPostal One, we can help. Growing your business is tricky, we know, and getting customers to trust you can be challenging, especially if you use your home as your business address. But renting an office space is expensive, and most virtual office addresses cost an arm and a leg. So what are your options? Well, at iPostal One, we've got you covered. You can get a business address at a real physical location, not a P.O. box. Choose from any of the thousands of addresses in our network and immediately upgrade your brand image. We receive your mail and packages, and all you have to do is view and manage your mail with our app or online. It's as easy as that. Upgrade your business image today with a digital mailbox from iPostal1.com.
These are all valuable tools, but they're just tools. They don't replace judgment. They don't replace experience. They don't replace the ability to read context and make split-second timing decisions based on incomplete information. The problem with algorithmic approaches to timing is that markets are not purely mechanical systems. They're made up of humans, making decisions based on incomplete information, fear, greed, hope, and desperation. These psychological forces create patterns, yes, but they're not perfectly regular patterns that can be captured by simple rules. The patterns evolve. They work until they don't. What worked in one market regime fails in another. An algorithm can't sense these shifts the way an experienced trader can. An algorithm can't feel that something is off, that the market character has changed in a subtle way that hasn't quite shown up in the data yet. This is why fully automated trading systems tend to work for a while and then stop working. Why the holy grail of set-it-and-forget-it algorithmic profits remains elusive for most traders. What technology can do is augment your decision-making. It can help you scan for setups that meet your criteria. It can help you backtest ideas to see if they have statistical merit. It can help you execute trades quickly and reliably. But the core timing decisions, when to enter, how much size to use, when to add, when to exit, these require human judgment informed by experience. The goal isn't to eliminate your involvement through automation. The goal is to develop your skills to the point where your timing decisions are consistently profitable, then use technology to execute those decisions efficiently. Here's a timing concept that nobody teaches: the importance of timing your trading activity to your own mental and physical state. You're not a machine. Your decision-making ability varies throughout the day, throughout the week, based on how rested you are, how stressed you are, how clear your mind is. If you're exhausted, distracted, emotional, or unwell, your timing will suffer. You'll miss signals you'd normally catch. You'll take trades you'd normally pass on. You'll exit at the wrong times because you're not thinking clearly. Professional traders understand this. They know when they're at their best, and they concentrate their trading activity during those times. They know when they're off, and they step aside entirely, rather than forcing trades with compromised judgment. I learned this lesson the hard way, taking stupid losses late in the day when I was exhausted, or forcing trades when I was emotionally upset about something unrelated to the market. Now I have rules about when I trade and when I don't. If I'm not well rested, I don't trade. If I'm emotionally agitated, I don't trade. If I'm distracted by personal matters, I don't trade. It's not worth it. The market will be there tomorrow. Missing one day of opportunities is nothing compared to the damage you can do to your account by trading with compromised judgment. This is another form of timing your participation to when you're capable of performing at your best. Let's discuss the timing of position management, because this is where many traders lose money, even when their initial entry timing is good. They enter a trade at the right time, the position moves in their favor, and then they proceed to mismanage it through poor timing decisions. Maybe they take profits too early out of fear. Maybe they hold too long and watch profits evaporate. Maybe they add to the position at the wrong time, increasing their risk just before a reversal. Maybe they move their stop loss further away when price approaches it, turning a small loss into a large one. All of these are timing errors in position management, and they're often more costly than entry timing errors. The key to good position management timing is having a plan before you enter, and the discipline to follow it. But your plan also needs to be flexible enough to adapt to how the trade actually unfolds, because markets don't read your script. If a trade moves in your favor more quickly than expected, that might actually be a warning sign of a climactic move that's about to reverse. If a trade moves in your favor more slowly than expected, grinding higher over days with constant small pullbacks, that might be a sign of strong hands accumulating, suggesting the move has legs. You need to be able to read these signals in real time and adjust your management accordingly, while still maintaining overall discipline and risk control. Here's a specific example. Let's say you enter a long position expecting a breakout, and within an hour, the stock has gapped up 5% on massive volume. Your plan was to hold for a 10% gain over a few weeks. What do? Many traders would just stick to the plan rigidly. I said 10%, so I'll hold for 10%. But that might be a timing error. The rapid climactic move suggests exhaustion, not strength. Smart timing would be to take at least partial profits immediately, locking in the quick gain, then potentially re-entering if the stock consolidates and shows signs of continuing higher. Rigid adherence to your plan without reading the actual market action is just another form of poor timing. Conversely,
sometimes baby steps turn out to be giant leaps.
How do you know when her diaper's wet?
Listen for the squish. When life changes lead to tax changes, don't navigate it alone. Get expert guidance from the tax pros who know the way. Shrinking, now streaming on Apple TV.
Some people spend hours digging through competitors' websites. You don't have to. Use SEMrush to instantly see where competitors get their traffic, so you can lean into what works and scale it faster. Analyze traffic on any website with SEMrush.
if your trade is working but slowly, grinding higher with healthy pullbacks and consolidations, that's a sign of persistent buying pressure. This is when you want to give the trade room to breathe, not cut it short because you're impatient. The timing decision here is to hold, to let the trade develop fully, even if it takes longer than you initially expected. Many traders do the opposite. They lose patience with slow-moving winners and cut them short, while they stubbornly hold fast-moving losers, hoping for a reversal. This is backwards. You want to be patient with your winners and ruthless with your losers. But executing this in real time, when emotions are running high, is where most traders struggle. The solution is to create decision rules that remove emotion from the equation. For example, if a position moves 10% in my favor in less than 1 day, I will take at least half off the table immediately, regardless of my initial profit target. Or, if a position is in profit but moving slowly, I will hold as long as it remains above its 20-day moving average, regardless of how long it takes to reach my target. These kinds of rules provide structure for your timing decisions while still allowing flexibility, based on actual market behavior. Over time, you refine these rules based on what works in your market with your strategy. Another timing consideration that's often overlooked is the timing of your position sizing adjustments. Most traders think of position sizing as static. You decide your size before you enter, and that's that. But professional traders adjust their size dynamically based on market conditions and their recent performance. When market conditions are favorable and they're trading well, they increase their size to capitalize on the good conditions. When market conditions are tough or they're in a drawdown, they reduce their size to preserve capital and reduce psychological pressure. This dynamic sizing is itself a timing decision, timing your aggression to when conditions favor it, and your caution to when conditions demand it. I've seen traders destroy themselves by maintaining the same position size regardless of conditions. They're in a drawdown, their confidence is shaken, the market is choppy and difficult, and yet they keep taking the same size positions, digging themselves deeper into a hole. The correct timing decision would be to dramatically reduce size, take only the highest probability setups, rebuild confidence and capital, then gradually increase size as conditions improve and their performance recovers. But ego gets in the way. They want to make back their losses quickly, so they maintain or even increase their size, turning a manageable drawdown into a catastrophic loss. The opposite mistake is staying too conservative when conditions turn favorable. The market shifts into a beautiful trending environment. Setups are working left and right, and yet they're still trading small size out of lingering fear from the previous drawdown. They miss the opportunity to make significant profits when everything is working in their favor. Proper timing means recognizing these shifts quickly and adjusting your approach accordingly. Aggressive when warranted, conservative when necessary, always appropriate to current conditions rather than stuck in a stance that made sense last month but doesn't fit today. Here's a final timing principle that ties everything together: the importance of timing your learning and adaptation. Trading is not a skill you learn once and then execute mechanically forever. Markets evolve. What works today might not work tomorrow. Volatility regimes change. Correlations break down. New technologies emerge. Regulations shift. If you're not constantly learning, constantly adapting, constantly refining your approach, you're falling behind. But there's a timing element to this too. You don't want to abandon a working approach at the first sign of difficulty. You don't want to constantly chase new strategies every time you hit a rough patch. But you also don't want to stubbornly stick with something that's clearly stopped working. The timing question is, when do you adapt and when do you persist? This requires honest assessment. Is your approach not working because market conditions have changed or because you're not executing it properly? Is the drawdown a normal fluctuation within the expected range of your strategy, or is it a signal that something fundamental has shifted? These questions don't have easy answers, but they're critical to long-term success. The traders who last decades in this business are the ones who can recognize when adaptation is necessary and when persistence is necessary, and who have the courage to act accordingly even when it's uncomfortable. In my own career, I've had to adapt numerous times. Strategies that made me fortunes eventually stopped working. Markets I dominated changed character. I had to learn new approaches, new markets, new ways of thinking about timing and risk. Each transition was painful. It's hard to abandon something that worked, even when the evidence is clear that it's not working anymore. But the alternative is to slowly bleed money holding on to outdated approaches while the market moves on without you. The timing of these strategic shifts, knowing when to adapt and what to adapt to, that's perhaps the highest level of timing skill there is. So here we are. I've given you everything I know about timing. I've explained the mechanical aspects, how to identify entry points, how to manage positions, how to time exits. I've explained the psychological aspects, how to remain disciplined, how to manage emotions, how to develop the patience necessary for excellent timing. I've explained the strategic aspects, how to specialize, how to adapt, how to approach learning in a way that actually builds skill rather than just burning through capital. The question now is what you'll do with this information. Will you take it seriously, implement it systematically, and do the hard work necessary to develop these skills? Or will you skim through it, think, that's interesting, and then go back to making the same timing mistakes that have been holding you back? The choice, as always, is yours. But I promise you this, if you master timing, really master it, you'll never look at trading the same way again. And more importantly, your results will reflect that mastery in the only way that truly matters. Consistent profits that compound over time, turning small accounts into large ones, turning uncertain beginnings into secure futures. That's what timing can do for you. Now go out there and do the work to make it happen.
The way you see an idea in your mind. The way you describe it to a friend. This is how website creation should be. Expression as natural as thinking. Let it out. Shape it into something that could only come from you. This is the new way to create. Wix Harmony.
The Chase Inc. Business Unlimited card helps you earn with ease with unlimited 1.5% cash back on every purchase.
The Chase Inc. card has been with us from the very beginning. I don't think we could have done it any other way.
Chase for business.
They say a man isn't truly tested until he has lost everything. I should know. I've been broke more times than I care to count. Each time, the world looked at me like I was finished, and each time, I clawed my way back. Not because I was smarter than the market, but because I learned something most traders never do. How to lose without being destroyed by it. If you are watching this, chances are you've been hit hard. Maybe you've blown through your account. Maybe you've made the same mistake 3, 4, 5 times in a row. And now you are sitting there wondering if you've got what it takes to survive in this game. Let me tell you something. Losing streaks don't just take your money. They take your confidence, your clarity, your belief in yourself. And if you don't know how to rebuild after that kind of devastation, you'll never make it as a trader. I am Jesse Livermore, and I've made millions and lost millions more times than most men will ever see $1,000. But I am still here, and I am going to show you exactly how I came back from the edge. Not just once, But every single time the market tried to bury me, the first thing you need to understand is this: losing is not the problem. Losing while lying to yourself about why you lost, that is what kills you. When I was young, I thought I was invincible. I made money fast, and I convinced myself it was because I was brilliant. Then the market humbled me. It took everything I had, and I was left standing there with empty pockets and a bruised ego. Most traders, when they hit a losing streak, they do one of two things. Either they freeze up completely, too terrified to pull the trigger on another trade, or they go wild doubling down, chasing losses, trying to win it all back in one desperate swing. Both roads lead to the same place, ruin. I've walked both of them, and I am telling you right now, if you want to rebuild your confidence, you have to resist both of those impulses with everything you've got. Here's what I did instead. I stopped completely. When the losses piled up and I could feel that dangerous energy creeping in, that voice telling me I needed to get back in the game right now, that I couldn't afford to wait, I forced myself to walk away. Not forever, just long enough to let the emotion drain out of me. Because emotion, my friend, is the trader's worst enemy. It clouds your judgment. It makes you see patterns that aren't there. It turns you into a gambler instead of a speculator. I'd go days, sometimes weeks, without making a single trade. I'd watch the market, sure. I'd study the tape, observe the price movements, and note the patterns. But I wouldn't touch a thing. And you know what happened during that time. My mind cleared. The desperation faded. I started seeing the market for what it actually was again, instead of what I needed it to be. That is the first step in rebuilding confidence. You have to separate yourself from the outcome long enough to think straight again. Now, I know what you are thinking. Jesse, I can't afford to wait. I need to get this money back. I understand that feeling. I felt it in my bones. But here is the truth. You can't afford not to wait. Because if you jump back in while you are still reeling, while you are still carrying that weight of loss and desperation, you are going to lose again. And this time, it'll hurt even worse. The market doesn't care about your bills. It doesn't care about your timeline. It moves according to its own rhythm. And if you are not in sync with that rhythm, you'll get crushed every single time. So step one is simple, but it is not easy. Stop trading. Give yourself permission to breathe. Let the noise settle. And while you are sitting there on the sidelines, start doing the real work. The work that actually rebuilds confidence from the ground up. During those periods when I was sitting out, I learned something crucial about the nature of the market and about myself. The market is always there. It is not going anywhere. There will always be another opportunity, another setup, another chance to make money. But if you destroy yourself, mentally, emotionally, financially, by forcing trades when you are not ready, you won't be around to take advantage of those opportunities when they come. I remember one particular stretch after I'd been wiped out in 1907. I was devastated. I'd built up a fortune and lost it all in a matter of weeks. The temptation to jump right back in was overwhelming. Every day I'd sit there watching the ticker, seeing stocks move, calculating what I could have made if I'd been in those trades. It was torture, but I knew, deep in my gut, that I wasn't ready. My judgment was compromised. I was wounded, and wounded animals make mistakes that get them killed. So I waited, I watched, I studied, and slowly, gradually, something shifted inside me. The panic subsided. The desperate need to prove myself began to fade. I started to see the market with clear eyes again. I noticed things I'd been too emotional to see before: the patterns, the rhythms, the way certain stocks moved in relation to others. I was learning again, instead of just trying to make money. This waiting period isn't passive. It is not about giving up or running away. It is about strategic retreat. It is about giving yourself the space to heal and to learn. Think of it like a boxer who has taken a beating in the ring. He doesn't jump right back into another fight the next day. He goes back to the gym. He works on his fundamentals. He studies tape of the fight to see where he went wrong. He lets his body recover and his mind sharpen. Only then, when he is truly ready, does he step back into the ring. The same principle applies to trading. You've taken a beating. You need to go back to basics. You need to let yourself recover, and you need to be honest about how long that takes. For some people, it might be a few days. For others, it might be weeks or even months. There is no shame in that. The only shame is in lying to yourself about being ready when you are not. During this time, I also learned to be selective about who I listened to and what I exposed myself to. When you are recovering from losses, you are vulnerable. You are looking for answers, for reassurance, for someone to tell you it is going to be okay. And there are plenty of people out there who will take advantage of that vulnerability. They'll sell you systems, give you hot tips, promise you easy money. Don't listen to them. The only person who can rebuild your confidence is you, and the only way to do it is through honest self-examination and disciplined practice. I also made a point of staying away from other traders during these recovery periods, not because I didn't value their friendship or respect their opinions, but because when you are in a fragile state, it is too easy to compare yourself to others and come up short. You see someone else making money and you think, why can't I do that? What is wrong with me? But you don't see their losses. You don't see their struggles. You only see the highlight reel, and that comparison will poison your recovery. So I isolated myself in a sense. I focused inward. I asked myself hard questions. What were my real motivations for trading? Was it the money, the excitement, the ego satisfaction of being right? The more honest I was with myself, the clearer things became, and I realized that if I wanted to succeed long-term in this game, I needed to trade for the right reasons, not to prove anything to anyone, not to feed my ego, but because I genuinely understood the market and could read its movements better than most. This period of stillness and reflection is foundational. Without it, everything else I am going to tell you won't work. You can't build a house on a cracked foundation. You have to repair the foundation first. And that means stopping, breathing, and giving yourself permission to not be in the market until you are truly ready to return with a clear head and a disciplined approach. When I was on the sidelines, I didn't just sit around feeling sorry for myself. I went back to basics. I reviewed every single trade I'd made during the losing streak. I wrote them down. I looked at my entry points, my exit points, my reasoning at the time. And I asked myself the hardest question a trader can ask. Was I following my system, or was I winging it? 9 times out of 10, I found the same thing. I'd abandoned my rules. Maybe I got impatient and jumped in before my signal appeared. Maybe I held onto a losing position because I couldn't accept being wrong. Maybe I let one bad trade turn into 3 because I was trying to prove something to myself. Whatever it was, the losses weren't random. They were the result of me stepping outside my discipline. This is where most traders go wrong. They blame the market. They blame bad luck. They blame everything except the one thing they can actually control, themselves. But if you want to rebuild real, lasting confidence, you have to own your mistakes. Every single one of them. Because once you own them, you can fix them. And once you fix them, you stop being afraid of them. I started keeping a journal not just of my trades, but of my thoughts and feelings before, during, and after each one. What was I thinking when I entered? Was I calm or anxious? Did I follow my plan or did I improvise? If I lost, why? If I won, was it because I executed well? Or did I just get lucky?
Day in the life of a small PT studio owner. Top of my to-do list is check the candidates from our premium sponsored job post on Indeed. They're certified and I invite them to apply. Responses are usually quick, and I use my Indeed employer account to keep track of everything. And now, back to my real job.
Visit Indeed.com/hire now to sponsor a job today.
I took my Instagram story views from this to this, and I'm going to show you exactly how you can do the same. Go to ManyChat and sign up with a free account. ManyChat is meta approved, so there's no need to worry about getting shadow banned. Then you're going to go over to automation and click on new automation. ManyChat has tons of pre-made flows that you can choose from, so you're going to choose the second one that says story reply. Then you can select if you want this automation to work on all of your stories or a specific story. Then you're going to set up a specific keyword that you want your audience to reply with. For example, guide. Now you're ready to customize the message that your audience will receive when they reply to your story with that specific keyword. You can use this ManyChat strategy to deliver your audience a freebie, valuable information, or even a product. And the reason that this strategy works so well is because as more people start replying to your story, Instagram sees that as engagement and then pushes your story out to more people.
This process was brutal. It forced me to confront the parts of myself I didn't want to see, the impulsiveness, the arrogance, the fear. But it also gave me something invaluable: clarity. I could see the patterns in my behavior, and once I could see them, I could change them. Let me give you a specific example. After one particularly brutal losing streak, I sat down and went through every trade I'd made over the previous 3 months. I laid them all out on paper: entry price, exit price, the reasoning behind each decision, what I was feeling at the time. And a pattern emerged that I hadn't noticed while I was in the thick of it. I was entering trades too early. I could see the setup forming, and instead of waiting for confirmation, I'd jump in because I was afraid of missing the move. Then, when the trade didn't immediately go my way, I'd panic and cut my losses too quickly. Or worse, I'd hold on, hoping it would turn around, and end up with an even bigger loss. Once I saw this pattern clearly, I could address it. I created a rule for myself. I would not enter a trade until I saw 3 specific confirmations, not 2, not, "it looks pretty good." 3 clear, unmistakable signals that my setup was valid, and I would stick to that rule no matter what, even if it meant missing some trades, even if it meant watching a stock take off without me, because I knew that my problem wasn't missing opportunities, it was taking bad trades out of impatience. This kind of self-examination requires brutal honesty. You can't sugarcoat things. You can't make excuses. You have to look at your failures and call them what they are. I was impatient. I was undisciplined. I was letting my ego override my judgment. These aren't comfortable things to admit, but they're essential, because until you can name your demons, you can't fight them. Here is what I learned. Confidence doesn't come from winning. It comes from knowing you can trust yourself to follow your rules, no matter what. When you've lost big, your trust in yourself is shattered. You second-guess every decision. You hesitate. You override your instincts at the worst possible moments. The only way to rebuild that trust is to prove to yourself, little by little, that you can stick to your system, even when it is uncomfortable, even when it is boring, even when every fiber of your being is screaming at you to do something else. So I started small. I didn't jump back into the market trying to make back everything I'd lost. Instead, I made tiny, controlled trades positions, so small they barely moved the needle financially, but big enough that I had to treat them seriously. And I focused on one thing only: execution. Did I follow my entry rule? Did I follow my exit rule? Did I manage my emotions? If the answer was yes, I considered it a win, regardless of whether I made money. And if the answer was no, I stopped again. I didn't care how long it took. I was rebuilding my foundation, brick by brick. This is the part where most traders give up. They want the big win. They want redemption. They want to feel like a champion again. But champions aren't made in one glorious moment. They're made in 1,000 small, unglamorous decisions to do the right thing when nobody's watching. If you can master that, you'll have something more powerful than confidence. You'll have self-respect. And self-respect is what carries you through the next storm. I treated these small trades like a craftsman treats his practice pieces. A master carpenter doesn't just start building houses after a long break. He goes back to his workshop and makes small joints, practices his cuts, gets his hands reacquainted with the tools. That is what I was doing. I was getting my trading hands back. I was relearning the feel of the market, the rhythm of price movements, the discipline of waiting for my setups. And here is something interesting that happened during this process. I started to enjoy trading again. When you are in a losing streak, trading becomes painful. Every decision is fraught with anxiety. Every loss feels like a confirmation that you are no good. But when I was trading small and focusing purely on execution, the pressure was off. I wasn't trying to make back my losses. I wasn't trying to prove anything. I was just practicing my craft. And in that space, I rediscovered why I loved this game in the first place. I also developed a scoring system for myself. At the end of each trading day, I'd give myself a grade, not based on profit and loss, but based on how well I executed my plan. Did I wait for my setups? Did I manage my risk properly? Did I stay emotionally balanced? If I did all those things and still lost money, I'd give myself an A. If I made money but violated my rules, I'd give myself a C or D. This shift in perspective was revolutionary. It took the focus off outcomes, which I couldn't control, and put it on process, which I could. Over time, something remarkable happened. As I racked up more and more days of disciplined execution, my confidence began to return, not because I was winning every trade, but because I was proving to myself that I could be trusted. I was showing myself that I had the discipline to follow my system even when it was hard, even when I didn't feel like it, even when every instinct was screaming at me to do something different. And gradually, the wins started to come, not because the market had changed, but because I had. I was trading from a place of clarity and discipline instead of desperation and emotion. I was taking only the highest probability setups. I was managing my risk properly. I was cutting my losses quickly and letting my winners run.
How can my brand appear in AI search? How can I boost digital brand visibility? Introducing SEMrush One, uniting traditional SEO and AI search tools, all in one place. Measure and grow everywhere you're discovered. One solution to win every search.
And the results reflected that transformation. This rebuilding phase taught me something profound. Trading is a skill that can be developed, refined, and mastered. It is not about luck or talent or having some special gift. It is about discipline, patience, and the willingness to do the hard work of self-examination and improvement. Anyone can learn to trade well if they're willing to put in the work. But most people aren't. Most people want the shortcut, the secret system, the easy money. And that is why most people fail. Now, let's talk about the mental game. Because this is where losing streaks really do their damage. When you've been beaten down by the market, it is not just your account that suffers. It is your identity. You start to wonder if you ever had what it takes in the first place. You look at other traders who seem to have it all figured out, and you feel like a fraud. You wake up in the middle of the night replaying your mistakes, feeling that sick weight in your stomach. I've been there. More times than I can count. But here is what I figured out. The market doesn't care about your feelings. It doesn't care if you are scared or confident or angry or hopeful. It just moves. And if you are going to survive in this business, you have to develop the same attitude. You have to separate your ego from your trading. Your worth as a person has nothing to do with whether you made money today or lost money today. Nothing. This was one of the hardest lessons I ever learned. I used to tie my entire sense of self to my success in the market. When I was winning, I felt like a king. When I was losing, I felt like nothing. And that emotional roller coaster nearly destroyed me. It wasn't until I learned to detach, to see trading as a skill I was developing, not a measure of my value, that I started to find real stability. So how do you do that? How do you stop taking losses personally? First, you accept that losses are part of the game. They're not failures. They're not proof that you are incompetent. They're just data. Every loss teaches you something. If you are willing to learn, maybe it teaches you that your timing was off. Maybe it teaches you that your risk management needs work. Maybe it teaches you that you are still trading emotionally. Whatever it is, there is value there, but only if you are humble enough to look for it. I started thinking of losses as tuition payments. I was paying the market to teach me. And the more I lost, the more expensive my education was. But it was an education nonetheless. Every mistake, every bad trade, every blown account, they were all lessons. And if I could extract the lesson from each one, then the loss wasn't wasted. It was an investment in my future success. This mindset shift was crucial. Instead of beating myself up over losses, I became curious about them. What could I learn from this? What did this loss reveal about my thinking, my emotions, my system? This kind of curiosity takes the sting out of losing. It transforms failure into data, and when you see losses as data rather than as judgments on your worth, they become much easier to handle. Second, you stop comparing yourself to others. There will always be someone making more money than you, someone who seems to have it easier, someone who never seems to lose. So what? Their journey is not your journey. Their wins don't diminish yours, and their losses don't excuse yours. The only person you are competing with is yourself. Are you better today than you were yesterday? Are you more disciplined, more patient, more consistent? That is all that matters. I learned this the hard way. Early in my career, I was constantly looking over my shoulder at other traders. I'd hear about someone who made a killing on a particular stock, and I'd feel envious and inadequate. Why didn't I see that opportunity? This comparison game was poisonous. It kept me focused on what I didn't have instead of on developing what I did have. Eventually, I realized that the traders I admired weren't thinking about me at all. They weren't concerned with how their success compared to mine. They were focused on their own game, their own development, their own edge. And that is what I needed to do. I needed to stop worrying about what everyone else was doing and focus entirely on becoming the best trader I could be. Third, you build your confidence outside the market. I found that when I was in a losing streak, it helped to focus on other parts of my life, things I could control. Things that reminded me I was capable and strong. Maybe that is spending time with people who care about you. Maybe it is working on your physical health. Maybe it is learning something new. Whatever it is, don't let trading be the only thing that defines you. Because if you do, every loss will feel like the end of the world. I took up physical exercise during one of my worst periods. Every morning, before the markets opened, I'd go for a long walk. The physical movement cleared my head. It reminded me that I had a body, not just a mind constantly churning over trading decisions. And there was something deeply satisfying about the simplicity of it. Putting one foot in front of the other, breathing fresh air, feeling my muscles work. It was a realm where effort directly translated to results. Walk for an hour, feel better, simple. Trading isn't like that. You can do everything right and still lose. But physical exercise doesn't lie. And that consistency, that reliability, helped ground me during a time when the market felt chaotic and unpredictable. I also reconnected with old friends who had nothing to do with trading. I'd let those relationships slide during my obsessive pursuit of market success. But when I reached back out, I found something surprising. They didn't care about my trading results. They cared about me as a person. We'd talk about books, politics, life, everything except stocks. And in those conversations, I remembered that I was more than just a trader. I was a human being with interests, relationships, and value that had nothing to do with how much money I made or lost. And finally, you have to develop what I call selective memory. Yes, you need to learn from your mistakes, but once you've learned the lesson, you have to let it go. Don't carry every loss around with you like a weight. Don't let past failures poison your future trades. When I step into the market, I am not thinking about the money I lost last week or last month. I am thinking about right now. This setup, this opportunity, that is the only thing that matters. The past is gone. The future hasn't happened yet. All you have is now. This was perhaps the most difficult mental skill to develop. Our brains are wired to remember threats, to hold on to painful experiences as a way of protecting us from future harm. But in trading, this natural tendency becomes a liability. If you are carrying the memory of every loss into every new trade, you'll be paralyzed by fear. You'll second-guess yourself. You'll hesitate at exactly the wrong moment. I had to train myself to wipe the slate clean each day. What happened yesterday is done. It is in the books. I've learned whatever lesson there was to learn, and now it is time to move forward. This doesn't mean ignoring your mistakes or failing to learn from them. It means processing them, extracting the value, and then releasing them. Don't let your past losses become a ball and chain that drags you down. I developed a ritual to help with this. At the end of each trading day, I'd review my trades, note my lessons, and then I'd literally close my journal and say out loud, "That is done." It was a physical and verbal signal to my mind that we were moving on. Tomorrow was a new day, a fresh start, a blank canvas, and I'd approach it with curiosity and readiness, not with the baggage of yesterday's mistakes.
H&R Block makes it easy to reserve time for your taxes. Tap us in, find a time that works for you, upload your docs ahead of time, and track your return from start to finish. It's all in the MyBlock app. Get started at hrblock.com.
You, just you, building your app.
on base 44. Describe it. And it's real. One thought leads to more thoughts. Layer by layer, taking shape. When you need your tools, bring them in. They just click. Okay, kick it up a notch. Create something smarter, something powerful. Style counts, so give it your touch. Big or small. Next idea hits at 2 a.m.? Of course it does. Keep building. Ask yourself, wait, I built this? Damn right. Base 44. Build it your way.
If you can train your mind to operate this way, to stay present, to stay detached, to stay focused on the process instead of the outcome, you'll find that confidence starts to return naturally. Not all at once, not in some dramatic transformation, but gradually, steadily, like the sun rising after a long night. You wake up one day and realize that you are not afraid anymore. You are not questioning every decision. You trust yourself again. And that trust, earned through patient work and honest self-examination, is unshakable. It is not based on a hot streak or a big win. It is based on knowing that you've done the work, that you've faced your demons, and that you've come out stronger on the other side. So here we are. You've stopped trading. You've done the hard work of analyzing your mistakes. You've rebuilt your discipline through small, controlled trades. You've worked on your mental game. And now you are ready for the final step. Trusting yourself again. This is the moment where everything comes together, or falls apart. Because no matter how much preparation you've done, no matter how solid your system is, there will come a time when you have to pull the trigger on a real trade, with real money on the line, and trust that you won't fall apart. That moment is terrifying. I know it is. I've stared at the ticker tape with my finger hovering over the order button, feeling that old fear creep back in. What if I am wrong? What if I lose again? What if I am not ready? But here is what I learned. You are never going to feel completely ready. Confidence isn't the absence of fear. It is the willingness to act in spite of fear. It is knowing that you've done the work, that you've prepared as well as you can, and that whatever happens next, you'll handle it before. You've survived every losing streak you've ever been through. You are still here. That is proof enough that you can do this. When I came back from my worst losses, the ones that left me broken, I didn't come back guns blazing. I came back quietly, methodically, with a deep respect for the market and a deeper respect for myself. I took my first trade, and it won. Then I took another, and it lost. And you know what? I was okay, because I'd done the work. I'd followed my rules. I'd managed my emotions. The outcome didn't define me anymore. My process did. That is the secret, if there is one. It is not about never losing again. You will lose. That is guaranteed. But it is about knowing that you can lose without losing yourself. It is about knowing that setbacks are temporary, that every losing streak eventually ends, and that as long as you stay disciplined, stay patient, and stay true to your system, you will find your way back. Let me tell you about one particular comeback that taught me everything I needed to know about trust. I'd been wiped out completely broke. I had to borrow money just to get back into the game. The pressure was immense. I knew that if I failed again, I might not get another chance. Every trade felt like life or death, but I'd done my homework. I'd analyzed my mistakes, rebuilt my discipline, worked on my mental game, and when the right setup appeared, I took the trade. My hands were shaking. I could feel my heart pounding. Every tick of the tape felt like it was judging me, testing me, asking, "Do you really have what it takes?" The stock moved against me initially, and that old panic started to rise. But then I remembered everything I'd learned. I remembered my rules. I remembered that one trade doesn't define me. I remembered that I'd prepared for this exact moment. I held my position according to my plan. I didn't panic. I didn't override my system. I just followed my rules. And the stock turned around. It started moving in my favor. And then it kept going. And by the time I closed that trade, I'd made back a significant portion of what I'd lost. But more importantly, I'd proven something to myself. I'd proven that I could trust myself under pressure, that all the work I'd done wasn't just theory. It actually worked. That trade wasn't special because of how much money I made. It was special because of what it represented. It represented the culmination of months of hard work, honest self-examination, and disciplined practice. It represented the transformation from a desperate emotional trader into a calm professional speculator, and that transformation, once achieved, became permanent. I'd crossed a threshold. I'd become someone different, someone better. I've made and lost fortunes more times than most people can imagine. And every single time I came back stronger, not because I was lucky, but because I refused to let the market break me. I refused to let a losing streak define who I was. And I learned slowly and painfully that the real battle isn't against the market. It is against yourself, against your fear, your impatience, your ego, your desperation. The market is just the market. It moves up, it moves down, it presents opportunities and takes them away. It is neutral. It doesn't care about you, but you care about you. And that is where the real work happens. Can you master yourself? Can you control your emotions? Can you stick to your discipline when everything in you wants to abandon it? Can you face loss without being destroyed by it? Can you face success without being corrupted by it? These are the questions that matter. If you can win that battle, you can win in this game. Not every day, not every trade, but over time, with consistency and discipline, you'll come out ahead. And more importantly, you'll come out as someone who has been tested by fire and forged into something stronger. You'll have the kind of confidence that can't be shaken by a bad trade or a losing streak, because it is not based on outcomes. It is based on character. It is based on knowing who you are and what you are capable of. So if you are in the middle of a losing streak right now, if you are feeling beaten down and hopeless, I want you to hear this. You are not finished. Not even close. This is just part of your education. The market is teaching you something right now. And if you are willing to listen, really listen, you'll come out of this a better trader and a stronger person. Take your time. Do the work. Rebuild yourself from the ground up. And when you are ready, step back into the arena with your head held high, knowing that whatever comes next, you can handle it, because you've already survived the worst. Everything else is just noise. The journey from devastation to redemption isn't a straight line. There will be setbacks. There will be moments when you doubt yourself all over again. There will be times when you wonder if all this work is worth it. But I am telling you, from someone who has walked this path more times than he cares to remember, it is worth it. Every painful lesson, every moment of self-doubt, every small victory along the way, they all add up to something profound. They add up to mastery. Not mastery over the market. No one ever truly masters the market, but mastery over yourself. And that is the only kind of mastery that matters. When you emerge from this process, you'll be a different kind of trader. You won't be reckless or desperate. You won't be arrogant or careless. You'll be steady, disciplined, patient, and wise. You'll have the scars to prove you've been through the fire. And those scars will remind you, every day, of what it cost to become who you are. They'll keep you humble. They'll keep you sharp. They'll keep you from ever taking this game for granted again. And that is when trading becomes more than just a way to make money. It becomes a practice, a discipline, a path of continuous growth and self-discovery. Every trade becomes an opportunity to apply what you've learned. Every win becomes confirmation that your system works. Every loss becomes another data point, another lesson, another chance to refine your approach. And over time, you develop something that most traders never achieve: consistency, not perfect consistency.
Usually getting a phone for $0 is too good to be true. A hassle. But not at Verizon. Now, when you make the switch to Verizon, America's best network, you can get the new Samsung Galaxy S26 Ultra for $0. No drama, no hassles. No trade-in needed when you get a new line on an unlimited ultimate plan. Talk about a no-brainer. Best network based on root metrics, best overall mobile network performance, US 2H 2025. All rights reserved. See Verizon.com for details.
That doesn't exist. But a reliable, sustainable approach that allows you to participate in the markets with confidence and clarity. This is what I want for you, not just to recover from your current losing streak, but to use it as a catalyst for transformation. To let it break you down so you can build yourself back up stronger. to let it teach you lessons that will serve you for the rest of your trading career, to let it forge you into the kind of trader who can weather any storm, who can face any challenge, who can survive and thrive no matter what the market throws at you. Because that is what separates the professionals from the amateurs. The amateurs think trading is about finding the right system, or the hot stock, or the perfect indicator. The professionals know that trading is about self-mastery. It is about developing the mental and emotional resilience to execute your plan consistently over time. It is about building the kind of confidence that comes not from winning, but from knowing that you can handle whatever comes, win or lose. So take this moment seriously. Take this losing streak seriously. Don't waste it by trying to rush back into the market before you are ready. Don't squander this opportunity for growth by blaming external factors or making excuses. Own it, learn from it. Use it. Let it be the foundation for everything that comes after. Because I promise you, if you do the work, if you commit to the process, if you rebuild yourself the right way, you'll come back from this, not just recovered, but transformed. And that transformation will serve you for the rest of your life. Now go rebuild yourself. The market's waiting. But more importantly, your future self is waiting. The trader you are capable of becoming, the person you are meant to be. That version of you is on the other side of this struggle. And the only way to reach them is to walk through the fire, do the work, and trust the process. If this video resonated with you, I'd love to hear which part hit home the most. Drop it in the comments below. Was it the importance of stepping back and letting your emotions settle? The brutal honesty of analyzing your mistakes? The mental game of separating your identity from your results? Or the final act of trusting yourself again? Let me know. And if you are serious about mastering the mental game of trading, make sure you subscribe and check out our other videos. There is a lot more wisdom where this came from. Hit that like button. Share this with someone who needs to hear it. And I'll see you in the next one. Before I begin, answer this quietly, just between you and the truth you avoid. If all you had was $100, would you treat it like the seed of your freedom? Or the excuse to gamble for a shortcut? Because the market has a way of exposing a man's character long before it ever exposes his strategy. And most traders fail, not because the market is too difficult, but because they cannot handle the humility of starting small. They want freedom, yet they refuse to respect the very money that could eventually buy it. When I first sat in front of the tape, I learned something few traders ever understand. Small capital is not a disadvantage. It is a test of discipline, a test of judgment, a test of whether you crave excitement or results. A man who cannot protect $100 does not deserve $10,000. And every time I watched a trader blow a small account, it wasn't the market that ruined him. It was his impatience with small beginnings. You might think $100 is insignificant, but let me tell you something only experience can teach. The market pays attention to how you treat your money. When you treat $100 like a toy, it behaves like one. It disappears the moment you get careless. But when you treat it as a soldier, a worker, a piece of capital charged with building your future, something changes inside you. You stop slinging trades just to feel alive. You stop clicking buttons out of boredom. You start trading with purpose, and purpose is the only foundation that compounds. What most traders truly fear is not losing trades, but facing the truth about themselves. With $100, you cannot hide behind leverage, complex strategies, or oversized positions. Your weaknesses are exposed. Every mistake is amplified. Every impulse costs you more than you can afford. And that is exactly why the small account is powerful. It forces you to confront the trader in the mirror long before the market punishes you on a larger scale. When I traded with small capital, I didn't envy the men with bigger accounts. I observed them. Most of them blew up faster than the beginners because size only magnifies recklessness. But the man who protects small capital with discipline learns something invaluable: the art of survival. And survival is the true beginning of financial freedom. You don't compound money until you first compound discipline. You don't compound your account until you first compound your control over your own impulses. If you want to turn $100 into something meaningful, you must stop treating it as a limitation and start treating it as training. The market is not testing your skill, it is testing your patience, testing your ability to wait for the trade that belongs to you, testing whether you can follow your rules when the whole world tempts you to break them. The small account is where a trader either grows into a professional or remains a gambler wearing a trader's mask. Because the truth is simple. $100 is enough to build freedom if you master the man holding it. The compounding does not begin in the account. It begins in the decisions, in the restraint, in the maturity to accept that trading is not about speed, but precision, not about constant action, but correct action. And the man who learns this with $100 becomes unstoppable with $10,000. Most traders misunderstand compounding because they only see it as numbers on a chart. They imagine the account doubling, tripling, surging upward, as if discipline alone guarantees speed. But compounding is not a mathematical miracle. It is a psychological transformation. A man compounds his money only after he has learned to compound his judgment, and judgment is built in the quiet moments when you decide not to enter a trade, when you decide not to chase, when you decide that your plan is worth more than your ego. With $100, every mistake is expensive. That is the gift. It forces you to create standards you should have had from the beginning. Standards most traders never develop because their larger accounts allow them to hide their flaws under temporary luck. But a small account exposes everything. It shows you where you hesitate, where you rush, where you justify nonsense because you want to feel like a trader instead of acting like one. And once those weaknesses are exposed, you are faced with a choice: confront them or repeat them. Believe me, I repeated mine long enough to learn the price of stubbornness. I chased. I revenge traded. I entered positions I had no business taking, simply because the tape moved sharply and I feared missing out. I watched profits evaporate because I refused to take them, believing the market owed me just a little more, and with each mistake the market responded the same way it always does, without sympathy. But slowly, painfully, through losses I could not afford, I learned the lesson. You cannot compound money if you cannot control yourself. The small account teaches you to wait, not because waiting is noble, but because waiting is necessary. You begin to notice something powerful. When you stop chasing every flicker of movement, the noise fades. Patterns become clearer. Opportunities stop feeling random. You start recognizing where the crowd panics, where the amateurs rush, where the market invites emotion from the weak and rewards patience from the strong. And when you take a trade from that state of clarity, even a small position feels like a victory of discipline, not luck. The trader who begins with $100 and refuses to break his rules becomes a different kind of man. He no longer needs the market to move quickly. He no longer needs big wins to feel worthy. He no longer trades to prove anything. He trades because the setup is there and because he has learned the most valuable mindset of all: that small, consistent progress is more powerful than dramatic swings. The market does not reward the dramatic. It rewards the patient. It rewards the steady. It rewards the man who is willing to let time be an ally instead of an enemy. That is where real compounding begins. Not with the trade itself, but with your refusal to destroy your account in pursuit of excitement. Every good decision adds to the foundation. Every avoided mistake strengthens your edge. Every patient entry compounds not just your money, but your identity as a trader who can be trusted with more. And trust, your own trust in yourself, is the true currency of financial freedom. As your discipline sharpens, something subtle but powerful begins to shift. The market stops feeling like a battlefield and starts feeling like a conversation, one you no longer interrupt with fear or impatience. You begin to notice the rhythm of price, the way it moves, pauses, tests, and traps. You stop reacting to every tick and start observing the behavior behind it. And with $100, this awareness becomes your greatest weapon, because awareness costs nothing, yet saves everything. Most traders never reach this stage because they blow their small account long before they ever quiet their mind. They tell themselves they need more money to take trading seriously, not realizing that seriousness is what creates more money. But when you approach $100 as if it is the last capital you will ever receive, your senses sharpen. You stop forcing trades. You stop pretending volatility is opportunity. You begin to understand the difference between movement and intention. And the market rewards you not with profit immediately, but with clarity. And clarity is the root of every profit that will later come. When I studied the tape, I realized this truth early. The market doesn't need to be predicted. It needs to be understood. And understanding comes only to the trader who is patient enough to watch without acting. When you allow the market to show its hand, your small account suddenly becomes capable of big decisions, not big in size, but big in quality, the kind of decisions that avoid losses others run into, the kind of trades that make you feel calm even before they move, the kind of entries that almost feel inevitable because your preparation was deeper than your desire to be right. This is when the small account begins to transform, not through explosive growth, but through intelligent preservation. You find yourself losing less, not because you're lucky, but because you no longer give the market your money out of emotional obligation. You find yourself entering better setups, not because the strategy changed, but because you changed. You're not trying to catch the move anymore. You're waiting for the market to invite you into it. And as the account grows from $100 to $130, from $130 to $180, you start to realize something liberating. It's not the money that is compounding, it's your behavior. The profits are merely the reflection. Your patience compounds. Your restraint compounds. Your ability to say no compounds. The fewer trades you take, the more intelligent they become. The more intelligent they become, the more consistent your account becomes. And consistency is the first true milestone of a trader who will one day achieve freedom. The amateur thinks freedom comes from big wins. The professional knows freedom comes from eliminating avoidable losses. When you reach the point where you trust yourself not to sabotage your own progress, the market stops feeling overwhelming. It becomes manageable, predictable in its unpredictability. You no longer feel the need to rush because you finally understand the truth. A single high-quality trade is worth more than 20 impulsive ones. And slowly, trade by trade, decision by decision, the account grows. Not because you discovered a perfect strategy, but because you became the kind of trader who can handle both winning and waiting, the kind of trader who is no longer at war with himself, the kind of trader the market cannot easily break. Now, the remarkable thing about starting small is that it forces you to respect the rhythm of compounding in a way a large account never could. With $100, you cannot afford impatience. You cannot afford shortcuts. You cannot afford the arrogance of thinking you know more than the market itself. Every decision must be deliberate. Every trade must have a purpose. And in this restraint, something extraordinary happens. You begin to internalize the principles of wealth that most traders chase their entire lives without ever understanding. I remember watching traders with enormous accounts panic at minor fluctuations, while the man with $100 moved calmly through the same market. He could afford to wait. He could afford to study. He could afford to lose nothing more than he had the right to lose. And by doing so, he avoided mistakes that larger accounts often amplify. The market rewards the disciplined, not the bold. It punishes the reckless, not the inexperienced. And in this truth lies the secret to turning a humble $100 into something that compounds into real financial freedom. Compounding in the account is meaningless if the mind does not compound first. Every dollar you protect, every impulsive trade you avoid, every moment you resist the urge to chase profits is a seed of strength. And these seeds, when nurtured patiently, create an internal structure so solid that the account will eventually reflect it. The man who can survive, who can watch, who can wait, he will be the one whose $100 grows into something the reckless cannot imagine. Let me be blunt. Impatience kills compounding faster than losses. Traders think growth is measured by percentage gains, but it is measured by repeated adherence to rules under pressure. If you cannot follow the plan at $100, you will never follow it at $10,000. If you cannot control yourself in moments of boredom or fear, no system, no strategy, no market movement will save you. Discipline is the currency that compounds. Patience is the lever. And integrity to your plan is the engine that transforms small beginnings into freedom. And when you finally understand this, something changes. The noise of every chart, every signal, every whisper of price action becomes a guide, not a temptation. You begin to act with intelligence rather than hope. You trade from observation, not emotion. And suddenly, what was once a tiny account becomes the canvas on which you paint the life you wanted. Not through luck, not through dreams, but through repeated, deliberate action. The man who masters himself with $100 has already won the war that the market cannot touch. And now, at last, the culmination of this journey reveals itself. The $100 that once felt small, fragile, almost laughable, has transformed, not because of some magical trade, not because of a sudden market move, but because the man holding it has transformed. He is no longer the impulsive beginner, the gambler chasing excitement, the man terrified of missing out. He is a trader of patience, of observation, of restraint. He is a man who understands that freedom is not bought in a single trade, but earned through repeated, disciplined decisions that honor both his money and himself. At this point, compounding is no longer merely financial. It is deeply personal. Every dollar now reflects the victories over your own weakness. Every gain is a testament to restraint when emotion demanded action. Every loss avoided is proof that you can outlast the impulsive, the impatient, the short-sighted. This is the mindset that transforms $100 into something capable of sustaining your independence. Because once you master yourself, the market cannot dictate your fate. Your habits, your judgment, and your discipline do. And here is the final truth. The freedom you seek has always been within your control. The money is just a measure of it. You started with $100, but the real account was never the balance. It was the trader who learns to wait, the trader who learns to observe, the trader who grows psychologically in the small, deliberate steps that most ignore. That trader does not fear the market. That trader is not enslaved to luck or whims of chance. That trader is free, no matter the size of the account. So when you hold that $100 in your hands, do not see it as trivial. Do not see it as a limitation. See it as a
The new Project Assistant can be used to quickly create prototypes or build the start of a new app from scratch.
UI check mode is a service that actually goes through your code and tries to find any potential issues.
We're now launching journeys where you get to describe a user journey in natural language.